All right, there you go. Welcome, guys. Welcome to the Introduction to Professional Trading 2. This is going to be Trading with Relationships with Pre-Market Preps, Joel Conan, Rob Friesen, and Dennis Dick. As you guys see, the experts here, we're going to be learning about the fundamentals of relationship trading, advanced trading techniques, risk arbitrage, and of course, for all my memesters out there, how social media can influence your trading. I know you guys are ready to hear from the experts themselves. We're going to be going, and I'm going to really quickly run through the agenda here so you know exactly what you're going to get. Dennis Dick will be the first one up talking about relationships tradings. We'll get into pairs trading and sympathy trading. Then we got Joel Alconen going into technical trading levels. So get ready for that. Then Rob will get into some execution tactics, basket trading, choosing markets, variations on entries and exit. Just get ready. I'm super excited to hear from Rob. I learn a lot from Rob myself because I'm a basket trader type. So if you guys want to learn about that, stay tuned for that. Then we'll get into a little bit more of in-depth with Joel on fundamentals, and we'll get into some with Rob about advanced trading techniques. And last, we'll have Dennis getting into risk arbitrage and social media stocks. Are you guys ready? Let me know in the chat. I want to see you guys hyped and pumped. Give us a thumbs up. It doesn't really matter about the algo, but we want to know your opinion and how you guys are enjoying the event. And like always, if you have a question, go ahead and at pre-market prep. What this is going to do, this is going to help me find all the questions, write them all down so that I could get your question answered. So if you want it answered, make sure that you're adding at pre-market prep. It's going to help me find them, and I'll go ahead and pass it on to the experts. Let them take over.
All right, I was going to start things out today, Mitch, and just real quick question for you guys. Do you know why we're doing this on Saturday, October 16th? I guess no one knows. There's no Michigan game I have to worry about. So we got a bye week. So that's the reason we're doing it today. So I'm gonna start my presentation here and then turn it over to Triple D. And Mitch, we're gonna get you going here. I will let you have the screen there to show the first slide, and then we'll get things going.
All right, pulling this up right now. Let's get this going here.
What we're going to be talking about here is, we're talking about, relationships. And then one thing you need to talk about relationships, you need to talk about, fundamentals, right? The fundamentals of the market change, right? And when they change, relationships change. So that's probably a big reason why you guys are here today. You guys listen to pre-market prep. You hear us talking about the fundamentals, the macros, the things that are going on that are going to change the relationships. And I think, one thing that Dennis has mastered over the years is identifying those changes in relationships and making the necessary adjustments. So I'm going to do a little technical and a little macro for you. And we're going to start out just a little bit with the longer term technicals here. And I'm just going to show you just something by the numbers. I think we get too caught up in a lot of the short-term trading, short-term things that happen in the market. So I like to take a look at things on a little bit longer perspective, and show you what I'm looking at, and look at things not so much on that real short performance, but look at it on a longer term performance. And just for the last quarter, you can see we made that all-time high in the S&P futures at 45.39.50. Our quarterly low was from July, 42.14.75, and it really seems like it seemed last week that, or the week before, that we were going to go down and test that low, but that didn't happen. I always like to keep an eye on the close for the quarter, and that was 42.97.75. And that just gets me to a quarterly pivot, and it's a number that I try and keep in my mind to go bullish or bearish based on that quarterly number. That turned out to be 43.50 for the upcoming quarter. And as you can see on the upper right chart, the market really had a lot of time deciding what it wanted to do, trading above and below it. We finally got that close above it, and then you see the market take off, and we ended up on the highs for the week. So there's taking a look at things on a monthly perspective. And so let's move on to what changes the relationships in the markets. And we got to talk a little bit, macro economics here. Well, first, just a real quick of everything I'm be doing here. I'm going to do the unknowns. Let's talk about the unknowns in the macroeconomic environment because that could really change the fundamentals and the relationships. And I guess the first thing that we could talk about is, economic data. As you know, the markets are worried about inflation. We get the inflationary data with the CPI and the PPI. And the market really just seems to be ignoring it. We have gotten some hot numbers, but we know where the Fed stands on these things. And the reason it's important to keep an eye on like the economic data and interest rates is because that's going to help certain sectors and it's going to hurt certain sectors. The other thing is like geopolitical events, and there's probably nothing better to talk about with that than what's going on in China. Those things that you cannot control really, with your technical analysis. If you're long Alibaba and you have things going on with China coming out, hitting the stock, hitting different sectors. So there's a relationship, and that's like impossible because you don't know what that headline out of China is going to be at, overnight. So it makes it a little bit more difficult. But then again, that's why you turn into PMP so we can, discuss those overnight events and what happens. The last thing, as far as the macroeconomics and the unknown, still in the midst of the pandemic here going on, over a year and a half. The reason that you have to, discuss that and be aware of that is, the reopening trade versus the stay-at-home trade, or is a stock both of those things. So those are the unknowns in the market. The econ data, geopolitical event, and then things like the pandemic, and then there's also other things that we don't know coming on further down the line that are going to change the relationships and how we look at individual stocks and individual sectors. So let's just move on to some more specific strategies here. Kind of just saying, okay, the macro is the macro situation. Interest rates are where they're at. Let's look at some price action and trying to come up with some trading strategies that that we can use under whatever environment or whatever macro situation is going on. And first thing I'm going to talk about here is you have the knowns, right? And the knowns are going to be earnings, right? We know companies are going to come out with Q3 earnings. We know that there's going to be expectations for those earnings, and price action before the earnings, during the earnings, and after the earnings are something that you can, is a known. You can observe the price action before, during, and after. So let's go. I'm going to go to the charts here and get my share screen up here. All right, still have the yes up here, but I just want to talk a little bit about something that went on this week in relationships and trading with the start of earnings season. You had J.P. Morgan was the first to report. I believe that was on Wednesday, and this. You really can't call it a pre-earnings run. We'll talk about that a little bit later, but it did had a very unusual move ahead of the earnings report from just over 150 up to that 171 and a half area. And we'll could talk about technicals in the second half of the of my presentation. But a triple top, people wanted to get out ahead of the report after such an extraordinary run. So it did have a pre-earnings run, but you did have a little bit of profit taking going into the report. Now, as it turned out, it was a mixed report, and you had J.P. Morgan, sell off, and this is the bar on the day where it had the report. So you looked at the reaction. The stock had a big run up. People were, taking a little bit of profit into the report, and you did have that down day. Now, the earnings overall, I mean, yeah, they missed a little bit on revenues. The EPS was pretty good. But what that did is it kind of set a low bar for Bank of America, meaning, okay, they uh, any kind of report that was better than the JP Morgan report would would be welcomed. And I noticed on the day when they were hitting that JP Morgan, on the day that actually came out with earnings, Bank America was going down, but it just seemed that the bounces were stronger. It had a little bit of a more pep in its step, right? And so right there, low bar set for JP Morgan, and then Bank America comes out and beats on both ends. And that stock immediately got a lift. And it's funny how that happened, that they just kind of brought JP Morgan along with the ride too, right? Because the banking sectors pretty much move together on a as a whole. And you had the report, and they liked the Bank America. Banks are back in favor. Kind of had a little bit of a double bottom there, and then you had the rally in both stocks for Bank America. Just looking at the chart, I talked about it hadn't traded in the 45 handle since February of 2008. It took out that level and had a breakout. So that was a pretty, an unusual move, but you had a continuation. You had the lower bar set for JP Morgan. It was easier for Bank America to clear, and then that is the price action that you had. So I'll move on to the next slide here, and a little bit going to everyone's favorite stock, or not everyone's favorite stock, but one that's like more historical here, with like a pre-earnings rally. Just anticipating good numbers from Apple. If you go through your Benzinga Pro and you look at the historical perspective, I don't think they've had a miss on EPS since like Q2 or Q3 of 2016. But just going back, this is just going back over the last year, right? This is what I have marked here, and I will bring my screen up, is the actual days that these stocks reported, correct? So here you have a nice run up 3 or 4 days into the report. This is when they actually came out with the Q1 report, and then you saw the price action. It sold off for the remainder of the quarter. And then you see going into Q2 report. I mean, people start doing this trade. Some people will do it 2, 3 days ahead. Some people will do it a week ahead, 3 weeks ahead. A lot of it depends on your size of your account, your positions or whatnot. But once again, you had, even if you were playing this on a shorter term basis, you did have Apple run up into the report. They had the report, had the spike, and then it ended up selling off. That's a lot of these people that are, investors that are trading this for the pre-earnings run. They'll take off a lot of the position, right? Because you don't know what actually can happen in the report, and it's just a strategy you can use ahead of the report and then worry about it afterwards. The Q3 report here, once again, running up into it, they didn't like the report is sold off. So from the perspective that we've seen with Apple, at least in this year, is it's had the nice run up to reported, then regardless of what the numbers are, they've been selling off. Now we have now we have Q4 coming up, and I believe they report October 28th, and we can move on to, I'm just showing it for the other time frames too. But here you are, you report on October 28th. Now, earlier this week, and I know it's a couple weeks before earnings, Apple came out with saying, lower deliveries because of parts, because of supply chain shortage. So, boom, you had this off, and it looks like people are using that. Now, it's still, today's the 16th, so there's still a couple weeks away. You also had favorable market conditions. But I would not be surprised if Apple continued to rally into the report, with people having the expectations that they will do what they always do and blow it away. So you can look at like different stocks, and there's different patterns that you see. I just wanted to bring up Amazon from last quarter. because ahead of the earnings, it had this really nice run up, but then the earnings were disappointing, right? And there was a big gap down. So in this situation, you had the run up into the report, you had the boat fully loaded with longs. The report was disappointing, and so it added an extra layer of selling, and then you could see what Amazon did after the report. So it's just keeping an eye on the calendar, looking what the trend. This works a little bit better with stocks that are in long-term uptrends. Stocks that are in downtrends, maybe you do have some selling into report, but since our market is just so long biased, this strategy seems to work a little bit better for the stocks that are moving up. And now we're coming into the heart of earnings season. So that's taking a look at the earnings, the pre-earnings rallies, and the movement from that. We went over with the Apple chart. Another thing that I just wanted to spend a little bit of time on was, and I'll go into more detail here in my second presentation. But levels are levels, and it takes institutions. I mean, we talk a lot about the shorter term trading and maybe the day trading, the swing trading, or things that are involved with options. But the bigger players in the market, that have hundreds and thousands of shares to move during a day or a week or a month. It takes them, a much longer time to do it. So there are levels that are established ahead of the report. And I'm just going for an example here with using Costco. Now, Costco had, made several attempts to clear the 470 area. This is before the report. You had a little bit of a run the few days prior. This was actually the day that they reported and went up and tried to kiss the all-time high. You had 3 highs in this area as a reference point, and then right after I believe this is a rup on earnings day, and this is the actual date of the earnings. So it was almost like no matter what Costco did, how good the earnings were, what the guidance was, there were firm sellers there at 470. So, and just under that was the all-time high. Now, you don't always see that kind of formation, but there's one where you're looking at the earnings, seeing where the larger players were. You see how it reacts into the report, and then that level, turned out if you started following it on this day, it was something that you could use 2 times, 3 times, 4 times, and even 5 times. And the other thing that I'd like to keep an eye on with things like this is, not only the all-time high, but the all-time closing high. Like where is the highest an institution is marked? The way stocks trade, if you get an all-time high, whatnot, it could be very, very little actual volume trading at that level. But at the close, a lot of institutions, larger players, are marked on that close, and they're using that all-time closing high as a reference as opposed to the regular high. And for Costco, 467.75 was the close on the day of the earnings. That just happened to be its all-time closing high. So even if you weren't focusing on the 470 area, focusing on the all-time closing high gave you a good level, a good exit point, or maybe a starting point for a short or an exit point for a long. And then just going into my final thing here for stocks, and this is after earnings. Once again, if you don't play the pre-earnings run and you're not getting down and dirty on the actual day of earnings, what I like to keep an eye on the actual closing price from that day of the earnings report, because after that, the institutions, the bigger players, are going to be making decisions based on that. And the best example for this one, and just going a little bit shorter term on this one, you're a long-term holder of JP Morgan, didn't play the pre-earnings run, you didn't trade it at the day on report. It got beat up pretty good, right? And the close on the day of the report that culminated in a 3-day losing streak for the stock. But it's focused like 161 should have been your focus area. That's where the stock closed on the day of earnings. And if you were using, to see how the street decides afterwards, keeping an eye or noting that 161 area, well, was a reference point of, hey, are they going to continue to take this lower after earnings? Or, hey, maybe the street has used it as a buy the dip opportunity. The following day, you did go through that level. You made a new low for the move at 160.06. But you came back up that day through that close. And if you were using that as a swing level for an entry, you're looking pretty good on that one. So there's just looking at some stocks, heading into an earnings report, looking at the price action on the day of the report, and then a little bit of a clue to look at the stock moving forward after the report. So I'm going to turn this over to Triple D here. I know he's got a big presentation to put for us, so I will take a look at the chat for some of the questions, and then I will stop the screen share and hand this over to Triple D.
Okay, I'm gonna just get my screen share going here in 1 second. I'm trying to just adjust some of the stuff here. Hang on.
Okay.
I'm gonna bring up the show.
Joel, just go ahead and bring your camera down while Dennis is up so that they'll only see Dennis.
Sure.
Thank you.
It says screen 2. So I'm gonna make sure I'm showing the right screen, hopefully. Okay. Introduction to pairs trading. You should be seeing my presentation here now.
You look great, Dennis. Let's kill it.
Looking good?
Looking good, man. Let's do this.
All right. So we're going to talk pairs here for the next, I guess, 38 minutes here. You got me. So again, premarketprep.com. If you're new, I think most of you guys know us by now. Everything I'm going to say today is for informational purposes only. Any trading ideas or stuff are obviously, consult your own investment advisor before making any trading decisions. But this is for informational purposes only. We're trying to teach you guys some different strategies. Obviously, all strategies don't work 100% of the time. My edge is if I have a strategy that can make money 52% of the time, the more I employ that strategy, the more money I will make. That doesn't mean I'm going to make on every single trade. It means I'm likely going to lose on 48% of them. But if you put on a trade 100 times a day, or even, a week or a month, you're likely to make money in the long run. So we kind of treat our business, and Rob will get into this too with Bright Trading. We try to treat our stock trading as a business, and we're kind of like the casino where we feel like we have the edge. So the more we trade, the more we're going to make. Again, you're never going to make money on every single trade. Don't expect that. It's a lot of larger numbers as you employ, if you have an edge, as you employ the strategy more, you should make more money in the long run. But on any given trade, on any given day, obviously you can lose money. So some of these strategies are evolving. Sometimes they work better than other times, but what we're trying to do is just give you an idea of what we're doing at Bright Trading. So I'm going to talk today about classic pairs trading. I've learned a lot. You're going to hear from Rob Friesen next. I've learned a lot of this stuff from Rob Friesen. Rob and Joel were my two mentors. You've got them both here on the show. Joel's taught me so much about the technicals. Rob's taught me so much about relationships. I'm excited to see Rob's presentation next. But I'm going to jump into pairs trading today. I'm going to talk about highly correlated pairs. I'm going to talk about newer relationships that I've discovered, and that can be the new ones because the algos probably aren't on them as much. Those edges can actually be pretty good. So, relationships are dynamic. They're constantly changing. So as you have, discover, new relationships, like the whole thing with COVID for a while there, for like a few weeks after COVID, the reopening trade and the stay-at-home trade was a relationship that really wasn't exploited. I know we even talked about it on pre-market prep with the whole Peloton, and I was like, I never liked Peloton stock, and it was down at $25. And when COVID happened, I was like, all of a sudden, I find myself buying Peloton. Jason Raznick was buying Peloton. Joel was buying Peloton, because we had a feeling that, if everybody's staying at home, Peloton's going to benefit from that. So, and then, what I discovered was a new relationship between Peloton and Zoom. And those two stocks all of a sudden became a pair. Two stocks that basically have nothing to do with each other became a pair because of the situation that the world was in. So we're going to talk about those types of new relationships. We're going to talk sympathy trading, where I look at the leader to trade the laggards. So for example, we're going into big earnings week. We just had the banks, where you're looking at those for indications. We'll be going to tech earnings, getting Netflix and Tesla next week. Intel we're going to hear as well. And then the following week, we're going to get into the big tech. So there's going to be lots of different sympathy trades to play as well. Piston trading is something where you've got a lot of stocks in the sector. We're going to talk about that, where the banks, for instance, there's 6, 7, 8 stocks will trade against each other. So not just trading 2 against each other, where there's 7 or 8 and they're moving up and down. So that's where you get the piston analogy. I don't know who came up with that. Maybe Rob knows in the next presentation, but I'm not sure if that was Rob. Don Bright might have came up with that analysis, but I believe somebody at Bright Trading came up with that. And then strategies at the open. We're going to talk about the open, which is one of the most inefficient pricing events. And this is actually where a lot of our traders make a lot of their money in that first 5 to 10 minutes of the day and right at the open, because a lot of times a stock will open too high or too low from where it should be trading. And it gives you a fantastic opportunity to get into a position at a really good price. So let's jump into this. Let's get going. Classic pairs trading. So basically, a pairs trade, if you're familiar, if you're just new to pairs trading, is just buying one stock in a sector and selling short another stock that's related. So we're going to get into a bunch of these examples on the next slide. But the big thing to know is that what you're doing is when you're buying one stock and you're selling short another stock, you're kind of trading market neutral to a certain extent, especially if you're using beta hedging. So what that means is if the market tanks the next day, like we lose 500 Dow points, you're not going to get crushed as bad because you got a short on too. So really, I don't care where the market is going when I'm trading market neutral. What I care is about the relationship and the pricing inefficiency between the two stocks that I'm trading. So it's trying to reduce market risk. You're interested in only the relative pricing, which I just talked about. And then there's a lot of strategies that are derived from pair trading. Sympathy trading is what I like the best. So we have a lot of classic pairs traders at Bright Trading. I'm more of a sympathy trader, where I'm using an indicator from a stock, saying this stock is trading down, so these stocks are likely to follow suit. Piston trading we just talked about, and crutch trading is leaning on one. We're not going to get into that too much today, but all crutch trading is leaning on something, leaning on one stock and taking a position on another one. So let's look at some classic pairs. We're just going to give you some of these, classic pairs, the different stocks. Coke and Pepsi. These two stocks, very highly correlated. A little bit different business models, where Pepsi's obviously, got a little bit more in the bar scene, in the restaurants. They've obviously, but for the most part, they're very close. I mean, you take the Coke, you take the Pepsi, can you tell the difference? So obviously in the market, sometimes you can't tell the difference either. UPS and FedEx, highly correlated. So what I'm showing you right now are very highly correlated stocks. UPS is up, FedEx is up. Cat and Deere, very highly correlated. In some instances, they can obviously deviate, but these two stocks are very highly correlated. Also, Tractor Supply can be thrown in there, TSCO, but Cat and Deere, we're kind of talking, on this slide, is relationships that are very, very highly correlated, two stocks. AT&T and Verizon, we're going to show you a slide of them in a second. Very, very highly correlated stocks. Morgan Stanley and Goldman Sachs, two brokers that directly compete, again, highly correlated. Home Depot and Lowe's, virtually identical businesses. Those two stocks, you put them on a chart, they look the same. Chevron, Exxon, I mean, all the oils, you can piston trade all those oils, ConocoPhillips. There's obviously all the big guns, but Chevron and Exxon are two of the biggest guns because there's such large components in the XLE. So you have some ETF arbitrage effects that keep those stocks trending together as well. Walmart and Target has deviated for the last few years, but again, they're still very similar businesses. CVS and Walgreens, again, they've deviated to a certain extent, where CVS has probably become the better company of the two. Years ago, we used to say Rite Aid was involved with them too, but Rite Aid obviously has had their own struggles there. So if I gave you this presentation 20 years ago, we probably would include Rite Aid in there. So obviously, businesses can struggle on an individual basis, and, these relationships can break down. But what we're trying to just tell you today is that there's a definite correlation between CVS and Walgreens. So let's look at the charts. I don't think a lot of people have looked, and a lot of people are giving, the hate to AT&T lately, and Verizon doesn't get any hate at all. These two charts, same exact time frame, 90 day. Look how virtually identical these two charts are. So there's ways to extract alpha from exploiting this relationship. AT&T was the definitive leader. It started breaking down through this 27th support ahead of Verizon. It may have only been a few minutes. It might have been a little bit longer than that, but AT&T was getting all of the media, all of the press when it started breaking down. Verizon getting none of the love, and Verizon having a fairly similar, almost identical move. So now Verizon and AT&T, I've actually had some people tweet at me. They are definitely different businesses, but you can see here that there is definite relationship. I mean, these two charts are very highly correlated to this breakdown being even almost identical. What's happening here? Why are these two stocks breaking down? Well, there's a number of reasons. The main reason is that if we start to go into a rising interest rate environment where inflation is hot, and you start to see inflation running 4, 5, 6, 7% on a regular basis, do you really want to be holding a stock that's making 4%, that's giving you a 4% dividend and doesn't have much growth? So I think you're starting to see this is actually the anti-inflation trade. So, and we do see this, in the TLT, we do see a relationship, with these stocks. As interest rates start to go higher, AT&T and Verizon will likely go lower. They trade more like bonds. If you put the TLT here, there's a definite relationship there too. But what we're trying to show you here today, obviously, is these two stocks are very highly correlated together, and you can extract alpha from that relationship. Walmart and Target's a little bit different. They're more loose. But if you look here, look at the two charts, the 90-day, they're fairly close. Now you can see here, I put this slides presentation together, I believe, on Wednesday. So this would be from Wednesday's candles. But you can see, when Target starts to break out, Walmart wasn't following suit. So on any given day, there may be a little bit of deviation, but overall, you can fairly see a fairly tight relationship. Not as tight as the AT&T and Verizon relationship, but fairly tight. And there are opportunities with AT&T and Verizon. I'm just going to give you an example. So it was back to, I believe, options expiration on September. You won't see this on the chart, but it was one day where AT&T opened up 1%. This, I believe, was the September option expiration. So going back to the third Friday in September, it was a great opportunity for pairs trader because AT&T opened up 1% and Verizon opened down 1%. Why did they do that? There was just a big buyer in AT&T and a big seller in Verizon. What happened? They opened here and they quickly came in. Within about 15 minutes, they came right back in line. So you say, okay, well, 1%, what 1%? And what's 1%? Well, I mean, a lot of people out there are trading for free right now. So if you can extract high profitability trades and make 2% on something in 15 minutes, it's a pretty good trade. Me at Bright Trading, I will enter a trade if I have an edge of 0.05%. So talking, just 5/100ths of a percent. If I have an edge, a statistical edge, I will enter that trade for as little as that. Now, at a retail account, maybe you don't want to be coming in for 5/100ths of a percent, but for 2%, anybody can participate in something like that. Now, that doesn't happen very often with AT&T and Verizon, but there's fractions of a percent all over on these things, especially at the open, which we're going to get to in a few minutes. So newer pairs, we were just hinting at this, continuing on with our presentation. Zoom and Peloton, two companies that really don't have anything to do with each other, but they're both stay-at-home stocks, meaning obviously Zoom has benefited from the pandemic. Peloton has equally benefited from the pandemic. And if you look at those two charts, there is a relationship there. And so what happens, you get bad news on Zoom one day, or maybe you get to Zoom breaking down. Maybe Peloton's lagging. I would try a short on Peloton to try to play a sympathy trade if Zoom was breaking down. The best opportunities are after 9:30, and I mean like instantly after. You see Zoom opening down, Peloton's flat, and Zoom continues to show weakness. The pairs traders naturally sometimes come in and start to bring that stock in. So a lot of times what you'll see is Peloton start to show some weakness. Now, remember when you're trading pairs, the one big thing to remember is there's individual stock news, which we're going to get to in the next slide, but there's individual stock news that can throw out the pair. So the best, situation for trading pairs is when both stocks don't have any news. If one stock has news, it's okay. And then just using that as a leader to trade that sympathy play. But sometimes, you get a situation where a stock is upgraded. Don't expect the other one to be just as strong. It's going to lag to a certain extent. AMC and GME is a pair that I've been trading for a while. You see the strength coming in AMC, you often see GME follow suit. Why? These are huge social media stocks that are widely followed. You've got the apes in AMC, you've got the GME holders that believe in the story there as well. Fundamentally, I don't understand any of it. I would not invest in these companies long term because I do eventually believe that fundamentals will catch up with them. But short term, price can deviate for a while from where fundamental value is. But all I'm saying is that because these two stocks, that companies that virtually have nothing to do with each other, no fundamental relationship between AMC and GME, but because they're social media stocks, because they're meme stocks, they tend to track each other. So there is a relationship there to exploit. You start seeing AMC breakdown. Sometimes GME can lag a little bit, and you might be able to get a short off on GME. Maybe AMC starts breaking out, and then you want to try to get a long GME. Moderna and BNTX, obviously, BioNTech. Obviously, these are COVID vaccine plays, and these two stocks are moving together. The reason I leave out Pfizer here is because Pfizer is such a big company, and the COVID vaccines is such a small portion of the revenue relative to the overall company. It's not going to impact the stock as much. But Moderna and BNTX are highly impacted by anything to do with the virus, anything to do with news. And if you bring up those two stock charts, you will see a relationship there. PayPal, Square, it's not that new. It's been traded for a while, but a lot of people still don't respect this relationship, and it's definitely there. You put those two charts on top of each other, they will look similar. Now, obviously, on a tick chart, everything looks different. I'm talking usually looking at the 90 days. So overall, what is happening? Are these two stocks tending to track each other? I mean, all tech stocks can track each other to a certain extent, but PayPal and Square are more closely related. Now, there was some news on Friday where Square was going to look into go into Bitcoin mining, and Square was getting a lift. This came out Friday after the bell. PayPal probably not going to lift as much because that was company-specific news to Square. Applied Materials, LRCX. This is one that our guys at Bright Trade. This is one, a fairly common relationship, both chip stocks. These two stocks very highly correlated. CRM and Workday. Obviously Benioff involved, I believe, in both companies, but CRM and Workday have a high correlation as well. Cloud plays, and some of the other cloud stocks can mix in there. They have higher betas. CRM and Workday tend to correlate well together. Snap and Twitter, you can also throw pins in here too. Those three stocks, I sometimes, piston trade those three stocks together where Snap starts breaking down. Maybe I'm going to be shorting Twitter. Twitter starts breaking out, maybe I'm going to be buying Snapper pins. There is definite relationship there. Remember, earnings can throw out. Obviously, we saw some deviation on the last earnings reports from these companies, but overall, there is a relationship there between Snap, Twitter, and pins. So let's talk reopening and stay at home. So obviously, you're reopening stocks, and this is something I have been playing for the last year. Obviously, before COVID, none of these relationships existed, but COVID gave us all new relationships. So you have all these stocks that just group together. And if you get, this reopening trade, if you get some positive news, like the Merck news there from the other day, the reopening trade started that morning. And we started to see some money go into the reopening stocks because, hey, if Merck can, bring down the symptoms of COVID, that's going to be people less scared to go out. There is people still scared of the virus, me being included in one of them. And I limit what I do to a certain extent. But if all of a sudden we can pop a pill to get, a lot less chance of getting sick, that's going to make me more confident to go out and do things. And that's what the reopening stocks really are. They're going out and doing things. Airlines, cruise lines, casinos, amusement parks, that's getting out in big groups and doing stuff together. So I just threw, some of the symbols. I didn't want to throw a whole pile of symbols, but obviously there's all the airlines and they're JetBlue. You can put in there too. The cruise lines, RCL, CCL, NCLH. And then Wynn Las Vegas, Sands, you can put Penn in there too, but Penn's got the online gaming, so it sometimes trends more well with DraftKings. Fun and Disney, are a couple of amusement parks. Obviously, Disney has a lot of other businesses, so it can be a little bit of a stay-at-home play with the Disney Plus. So it's kind of almost the best of both worlds. But still, the majority of Disney's revenue comes from the parks, and obviously, they want to get past COVID. And then you have the stay-at-home stocks, and we've seen some weakness in these over the course of the last few months because, hey, we're starting to get past the virus to a certain extent. We're maybe never going to beat it, but we're managing it a lot better. And as we manage it more, people will be more confident to go out and do things. So obviously the gaming stocks, you're sitting at home, you didn't know what to do last year, you're sitting out playing video games. Take-Two, EA, Activision, three of the big ones. Zoom and Peloton, we already talked to them as stay-at-home plays, and then Teladoc. So you're not going to see your doctor. TDOC was a way to bring the doctor right home to you. So obviously there's lots of other stay-at-home stocks too. I'm just giving you some examples here today, but there is a definite relationship there between these stocks and these stocks. Now that might not always exist. If we get past the pandemic, these relationships will just break down and not exist anymore. And I hope that happens one day. But as long as if you're getting COVID news, and if you have news that no people aren't talking, COVID's not being talked about in the media, maybe the relationship isn't going to be as strong that day. But if you have a strong COVID news day like that Merck day, you will see weakness in the stay-at-home stocks and strength in the reopening stocks. And you can exploit those trends. And you got to be quick. But at 9:30, people haven't figured it out yet. 9:40, they start to figure it out. By 10 o'clock, they've kind of figured it out. So sometimes it's a few minutes you have, sometimes it's a little bit longer, sometimes it's shorter. But there's those opportunities at the open, and I'm going to get into that too. Sympathy trading. So stock movement due to association with another stock. So example, Macy's reports bad earnings. What happens that morning? Well, Macy's goes down because it reported bad earnings. But what you often see happen is Dillard's, Kohl's, and Nordstrom's also move down in sympathy. So when these earnings reports are coming out, I see Macy's tank. I'm just trying to be quick to short Kohl's and short Nordstrom. Now, sometimes you can get a head fake where Macy's tanks and then all of a sudden starts to go back up. And I've been caught on the wrong side of that too, because the algos are on these trades too, and they will hit them fairly quickly. But sometimes, then you get a whipsaw action and Macy's all of a sudden starts ripping higher. Sometimes the best thing is the algo's all screwed up then, doesn't know what to do. So, if you see Macy's dip on the initial report, but then start blasting off, sometimes the Kohl's and Nordstroms just got offered down. Sometimes you can quickly buy those, and sometimes they will lift afterwards. So, notice what I'm not saying. I'm not trading Macy's, but I'm trading the sympathy moves, the moves that are happening after the fact. Dillard's is its own animal. It's actually been a Reddit stock before. You got to somewhat be careful. It's thinner too. I really like Macy's, Kohl's, Nordstrom's, these three. I kind of like trade all three of those against each other. If one's got bad news and it's really tanking, it might bring the other two down. Sympathy trading with Apple suppliers. I gave this in the last presentation, but it's such an important piece of information. I wanted to give it again. So Apple on, I believe it was Tuesday, I copied the warning there from Benzinga Pro at 4:02 right after the bell. Apple is poised to slash iPhone production. So the Apple suppliers, Broadcom, TI, but there's other ones, SWKS, AVGO, Broadcom, Cirrus, Logic, QRVO, OLED, Texas Instruments are all Apple iPhone suppliers. So if you have iPhone, you have a headline happening, Apple's poised to slash iPhone production, these stocks are going to get hit. There's a very, very high probability that these stocks are going to get hit. So you can see what happened with SWKS, the next morning, it kind of opened too high and then tanked. So, but even after hours, it was obviously trading. And I want to show you the next one, which is, I'm just going to jump down. Actually, I'll show it to you after. So I'm just trying to give you an example when you have Apple, with, good news on Apple iPhone production, and it will lift these stocks. Apple iPhone production. These are your Apple iPhone production. So write these ones down. I know you guys can tape this recording and go back to it, but these stocks move with iPhone news. It's important to know them. Piston trading, we just talked about this. It's trading multiple stocks in the sector. JP Morgan, Citigroup, Wells Fargo, Bank of America, Morgan Stanley, Goldman Sachs, all kind of move together, but sometimes you get deviations. It was a fantastic opportunity with Wells Fargo. 2 days ago was tanking, staying down. Well, what did it do yesterday? It ripped higher. It's playing the catch-up trade to try to catch up with the other banks, which were making new highs. So WFC, I believe, was up 6% yesterday. Huge move for WFC. Oil stocks all tend to move together. These are the big ones, that I trade. Chevron, Exxon, Conoco, the big three. You get into Halliburton, you get into Schlumberger. They're big components in the OIH. If you're trading OIH, and we will talk ETF arbitrage a little bit, those two stocks are huge components in that Hess. And then there's like 50 other oil stocks, smaller, that all tend to track, obviously, with the USO. So I was saying before, company-specific news can throw off relationships. Last week, we saw UPS get an upgrade. Well, FedEx is not going to be up as much as UPS because that was that was an upgrade to UPS, not to FedEx. FedEx does show a little bit of sympathy move, but when you get a stock upgraded, don't expect UPS to be up 5% and FedEx to be up 5%. UPS might be up 5%, FedEx might be up 1% in sympathy. It's not going to be as strong because that upgrade wasn't to FedEx. Sometimes you get these sector upgrades and those can move. Sometimes both stocks get mentioned. I've seen analysts just bullish one and bearish the other, and they come out and report and they say, we like Home Depot's better than Lowe's. We're upgrading Home Depot and downgrading Lowe's. Those two stocks will break apart that relationship. Eventually, they tend to come back in though. So, there's alpha to extract just from, trading those two, but not necessarily to do it on day one either. JP Morgan earnings last week, all the banks were showing some weakness. What that also did, which Joel touched on his presentation, was it set the bar lower for the other banks. So the JP Morgan report was okay, but they smacked the stock on it. They smacked some of the other stocks on the JP Morgan news. And then what that does is we had the next day where Bank of America was coming out and Wells was coming out, Morgan Stanley was coming out, and the bar all of a sudden set a little bit lower because the stock showed weakness off JP Morgan report. And what happened? They turned around and started rallying, and Bank of America made a new 10-year high yesterday, was what Joel was saying on the show. So let's go to this opening where there's lots of inefficiencies, and this is where I love to trade, is the OPG order. So the opening is a very inefficient event. One large buyer or seller, because when you're opening a stock, sometimes institutions just want to, big money wants to get in the stock for whatever reason. Maybe they've got a fundamental thesis. Fundamental traders aren't market timers. They are buying a stock for a long-term investment. So, and you got Fidelity or Temp, the big guns, BlackRock coming in. They're not so much market timers. They have some people that are trying to do it, but they don't do a good job of it. So you can take advantage of their inefficiencies where they're not caring where the stock's going in the next 5 minutes. They care where it's going in the next 5 years. We as day traders or short-term traders, even swing traders, care where it's going in the next 5 minutes. We care where it's going in the next 5 days. So because they don't care, we can take advantage of that. And obviously, in some cases, there's just a big buyer at the open, and maybe there shouldn't be. And I want to show you here just in this Texas Instruments example. So this is where I was going to get to. So what happened was on Apple, again, the warning from Wednesday morning, Apple cut production guidance. For whatever reason, there was a big buyer in Texas Instruments that at the open. Texas Instruments opened higher. That is absurd because we have all the Apple suppliers trading down on the iPhone production guidance cut. And they were trading down after hours, and they've traded down the pre-market. And then all of a sudden, you've got a big buyer, and Texas Instruments opened right at basically the high tick, 189.16, 48,000 shares. So somebody wanted in. That fundamental buyer, obviously it's probably a fundamental buyer because it's so much size, was not respective to the relationship and to the news that was happening that day. And they probably paid $2 too high for this stock. And you can quickly see that they did because it opened here. And within 30 seconds, it was trading down $1.50. That's where you, as relationship-based traders, can take advantage of those relationships. So this is an example from 2 days ago. Texas Instruments opened too high, came right in. Now it chops around, a little bit, obviously, but then continues to leak down. Where it goes 2-3 days from now, it's hard to say. But usually when that market impact happens, and you've seen every other AVGO was down 2-3 or a couple percent. Skyworks is down a couple of percent. Apple is trading down. Texas Instruments had no reason to be opening higher. So you as a trader can take advantage of that market inefficiency, that fundamental buyer that just paid too much for the stock. So how do I do that? What do I do? How do I get that Texas Instruments price? How do I get short that stock? Well, the nice thing is the exchanges offer you the OPG order. What this is, it's the opening only order. It will fill at the open or it automatically cancels the order. So what that means is I can place OPG orders on every stock in the sector. So offering them short. And if one opens a little bit too high, I will be short the stock. If it opens too low, I won't be filled and the order will automatically cancel. So if you're trying to do this on NASDAQ, it depends on your broker. You might have to, it might be called limit open on the NASDAQ, or it might be called OPG NASDAQ. Your brokers, and some of these like a Robinhood might not even offer this type of order. But Interactive Brokers definitely offers these orders. So it's called the opening, or it might be called limit open. Like I said, it might be called OPG. There's different brokers. And I mean, if you're at Robinhood, and I don't even know if you can short stocks on Robinhood, so it makes it a little bit more difficult. But you get what you pay for. I mean, if you're trading for free, you might not get all, the bells and whistles that you might get elsewhere. But I mean, Interactive Brokers, I always toot their horn. Like if you want to come to Bright Trading, that's fantastic. We'd love to have you at Bright Trading, where we give you all these tools. If you wanted to be a professional trader, but if you just want to dabble in the stuff, Interactive Brokers offers a lot of the stuff too. Limit open NYSE, limit open. So you got to know, obviously, if you just put limit open or OPG on Interactive Brokers, it'll automatically go to the exchange that it's listed on. So you use NASDAQ for listed NASDAQ stocks. You use NYSE for listed NYSE stocks because that's where that exchange is where the opening price will occur. So basically on the Texas Instruments example, what you would do in this case is if you feel like all of them are opening higher or opening, lower, and you want to place them out there, I cherry pick OPG orders all the time, meaning I put out, okay, there's Apple, bad news for the suppliers. I will offer short SWKS, OPG, maybe 20 cents down from the close. Just say if it opens slightly down, it's trading way down the pre-market. If it opens slightly down, I'll short the stock. And I send them all out. And, and all of a sudden you could get like a Texas Instruments short on, and it would be a good trade. I had one of these on DKNG on Friday, which was good as well. So just showing you, different opportunities. So we talked about the order placement. I want to talk about, the TLT. I only got 9 minutes here left, so we're just going to keep going through the presentation. I have a second presentation, which is going to overlap some of this stuff. We're going to get into different types of arbitrage, more relationships, but today I'm just trying to give you the basic fundamentals. This was an introduction to pairs trading, so you got a basic understanding of different relationships that exist that the pros are using. Because believe it or not, most professional traders aren't trying to make market calls. They're not out there. Citadel isn't saying, I think this stock's going here. I think this stock's going there. I'm going to bet all my chips on it. Most professional traders are not trying to make directional bets, thinking, hey, this stock's, I'm going to buy here and it's going to go here. They're taking advantage of relative pricing and efficiencies. They're looking at this, and if the stocks go here, they're shorting the higher one and buying the lower one and then hoping it comes in. I mean, that's how arbitrage is done, which we're going to get to in our next presentation. We're going to really dive into ETF arbitrage and, pair and risk arbitrage and the different types of relationships. That'll be in an hour. But professional traders, for the most part, aren't making directional bets. They're taking advantage of market inefficiencies. So the TLT, again, I talked about this in the show a lot of times, but it's such an important relationship. I've got to say it again in this presentation. The TLT is inversely correlated with the banks. When I'm looking to trade a bank on the day, I'm not caring as much about where the S&P futures are as much as I'm caring about the TLT. If the TLT is trading down $1, I know the banks are going to probably be trading higher. If TLT is trading up $1, the TLT is the 20-year treasury. If the TLT is trading up $1, I know the banks are likely to be trading lower. Now, there is a looser relationship between a positive correlation between the REITs and the utilities, and even like AT&T and Verizon, because the TLT is a bond. So you're looking at it there. So if the TLT is trading down, REITs will relatively be there, trading down a bit. Utilities often will be trading down, but the relationship isn't as strong there. It's very inversely related between the TLT and the bank. So my bread and butter, and I probably make a lot of money using this, is trading that inverse correlation between the TLT and the banks. Why? Okay, well, think about it. We'll just read it right to you. If the TLT is down, that means that long-term rates are trading higher. That's good for the banks. The banks want higher rates. It's bad for stocks with higher dividends because those higher dividends are less attractive if rates are on the rise. And that's why AT&T and Verizon have been showing weakness. If rates are on the rise, that AT&T and Verizon, if inflation is hot, that AT&T and Verizon 4% dividend. I'm saying AT&T is 4 because the dividend was slashed. You look at your system, you see 8, but that was from the last quarter. Going forward, the dividend has now been halved. So that 4% dividend you're getting from AT&T and Verizon is a lot less attractive when inflation is running at 5%. It means you're losing. If you don't have positive stock performance, you're actually losing. So just sitting there collecting 4 or 5% isn't good enough when inflation is running 5%. So if rates were on the way down, AT&T and Verizon would probably be trading higher. If rates are on the way down, TLT is trading higher. That's why that relationship is there. TLT up, so we can do piston trading there. If the TLT is higher, I use those OPGs. So let's say the TLT is up. So we know that the banks have a correlation, a negative correlation with the TLT. So if TLT is $1, I will often offer, like, you've got 50 banks out there, but the big 6 or 7, I will offer them short at the open using that OPG, anticipating that if a bank actually opens higher on the day the TLT is up, probably arbitrage trader, probably professional traders will bring it back in, meaning that there's probably going to be some weakness showing there. So sometimes you have JP Morgan, Citigroup, for whatever reason, just open higher on a day the TLT is showing a lot of strength. It's probably, there's a high probability. I don't know what the statistical edge is, but it's probably greater than 52%. It's probably shooting up at like 70%, to be honest, where the banks, well, that bank will come back in, especially some of the other banks. Now, if there's company specific news, let's say Citigroup's upgraded and TLT's trading that day, well, that impacts Citigroup's price too. So that upgrade probably overpowers the fact that TLT is trading higher. But other things being equal, if there is no news, if the TLT is higher, the banks will typically be trading lower. So we got this done with 5 minutes. Joel started early. I had it for 30 minutes. He gave me the extra 8 minutes. So I can actually field a question or two right at the end of this too. But in summary, learn the relationships, learn your different pairs. There's lots. Rob's going to jump into this too, but there's lots of, different relationships out there. I've given you quite a few here today, some of the basic ones. Some of them are common sense. Some of them you got to think about a little bit more. But as relationships are dynamic and they're constantly changing. So, that Peloton Zoom, obviously Teladoc are all related to each other to a certain extent, at least right now, because of COVID. COVID is the common ground there that makes those stocks related to each other. Obviously, Activision, Take-Two, and EA are always related to each other, no matter what the environment. Now, there can be specific game news on EA, which could, impact EA specifically. And when you see specific game news, that's likely not to impact the performance of Activision or Take-Two. So it's often, as a pairs trader, you've got to sometimes ask your question, why is that stock trading down? If it's because, they missed, they're missing a target and the game's going to be delayed, well, that probably, it doesn't impact Activision and the other one if EA's, got a game delay. So you've got to respect that to a certain extent too. The company specific news can impact those relationships, at least for that day. You take advantage of professional traders looking to take advantage of relative pricing inefficiency. I keep saying professional traders, but because the world we're in now, where trading is so cheap for everybody, if you're trading for free, you can exploit some of these relationships as well. And maybe you're just coming in and you like the chart. Maybe you want to buy the stock for your longer term investment. But if every trader at the point of execution, so even Warren Buffett is a day trader when he's trying to buy or sell a stock. He's a day trader at that moment in time, and if he could just time his entry or exit a little bit better, maybe he saves himself 0.5%, maybe he saves himself 1%. So even if you're thinking about, I love the chart, I love the setup, understanding these relationships that I'm talking about more will likely give you a better price. Even if you only make 3 trades a year, but you understand the setups and you understand the relationships, you're likely to get a better price. And that's what we're trying to help you with today. Sympathy trading. I love sympathy trading. Stock showing weakness, certain companies. We gave the Macy's example, but there's so many other examples, even to the point, and we're going to get in the next slide with ETF arbitrage, where Apple's showing weakness suddenly, Amazon, Facebook, Microsoft all go down in sympathy together because they're all part of FANG. They're all part of these ETFs, where you got the FNGU, which is 10% of, each of these 10 big companies, these big tech companies. So there's all those effects that make those companies more correlated as well. Even though Microsoft and Apple are two fundamentally different companies, they tend to trade together because they're big market caps. They are big components in SPY. They are big components in the Qs. They are big components in FNGU. They're big components in a lot of ETFs. So there tends to be a relationship there between Apple and Microsoft, even though these two companies are often in competition with each other. And then we try to exploit the inefficiencies at the open. I believe this is the most inefficient event, in my opinion. The close can sometimes be too, but the close is a lot of more players. There's a lot of institutions. A lot of times you don't see the movement like you do at the open. The open's a little bit thinner, where stocks just tend to, open a little bit too high or too low. So anyways, I hope you guys enjoyed the presentation. I am going to pass this over to Rob 1 minute early to get him ready. So if you have any trading questions or you want help trading, you can always ask in the chat here today on the YouTube chat or at Triple D Trader. Tweet at me. I will answer those questions if you've got specific trading questions. I try to get to as many as I can. So I'm going to stop my share now.
Yep. Go ahead and stop your share, Dennis. You can stay on. What I want to do right now is I want to take a second to do a little bit of a Q&A. So sure. Joel and Rob, if you'd like to turn on your camera and turn on your mic, you can join in. I'm going to ask some of the questions that I've already seen in the chat, because one thing that I don't want to get too far away is you have that train of thought. You're trying to get that train of thought answered. Let's go ahead. Let's knock out some of these questions, and then we'll get into Rob's presentation here. We've been doing really great. Got a lot of questions here. Some have already been answered. So if it was already answered, maybe by one, maybe we can go to another opinion here. I'm going to start running through some of these. So if you could choose one and only one of these time frames to trade, which one would you choose and why? And so we have three different time frame choices here: 8 to 9:30, so pre to the open; 9:30 to 11, pretty much the open and the big commotion; or at the close, more 2:30 to 4. I'll go Dennis first, and then I'll work down the list.
I like all those time frames. Those are the correct time frames, I will say. If you would have put 11 to 2 on there, I would have say avoid. A middle of the day, and this is where I think a lot of newer day traders have struggles, is in the middle of the day. The high frequency traders, there's a lot of chop, there's a lot of slop, and the market is, fairly efficient there. So you're not going to take advantage of any of the stuff I just talked about today between 11 o'clock and 2 o'clock. The best chance to take advantage of the relationships that I was just talking about is somewhat in the pre-market, a lot at the open, somewhat at the close, somewhat after hours. There's some news and stuff, but you're trading 11 to 2. You're in what I call the difficult algo hours. Those are where the algos are dominant, and they're coming in and they can actually hunt you down. And don't kid yourself. You put your bid out there, on a thinner stock, they'll take the offer and then it's bid higher on you, and they take the offer because now you showed your hand. So they're running on you, and you see a lot of that in the middle of the day. At the open, you don't see it as much. You do see it. You see it all the time. But I tell you, in the middle of the day, it's a lot. It's a lot more difficult because the algos are really hungry.
All right, let's go. Joel, what would you pick if you had a time frame?
We discussed this and this is really where pre-market prep, emanated from when Dennis and I were talking several years ago. And just from my observations in the index futures overnight, I started talking to him about, potential inefficiencies in the equities. And that is really where, he expanded his trading. I agree. The opens now. The only thing I'm going to throw in there that'd be a little bit different is the 6 p.m. open for the futures. I do derive my levels off the 24-hour market in the index futures, and what I have found just over the years is that you can set up some really low risk trades off that open based on the way the market closes, the momentum, the direction. A lot of times, you don't even get a shot at the closing price. Would be a good example yesterday in the S&P futures, where you only had one chance to buy the closing ad, and that was off the 6 p.m. open. So I think that's an important time frame. I think the 9:30 open can help you set up trades for good risk reward ratios. I also think, and we discussed this a lot, and I don't know how much people are trading on a pre-market and after hours scale. But man, some of these 4 a.m. moves, as we know, the equities close at 8 and then reopen at 4. And just sometimes, whether it's nefarious activity or people just getting overexcited, there's just some excellent price action at those times. A lot of times where you see levels that you don't see the remainder of the day. And just as far as like the pre-market and the after hours trading, it depends on your broker, depends on your size of the account. I think if anything, at first, maybe try and look at it as like potential exits. Like if you have an exit in a stop and you don't know if it, and it has extraordinary move in the pre-market or after hours, if that's your target, you're taking your chance, and it also could continue that way. So I think it would be first if you're going to use those time frames, the after hours and the pre-market, at least start, looking at it to see, hey, could I have gotten my exit price on that? Entries are a little bit more difficult. But definitely emphasizing the open. I'll agree with him on the midday chop and slop. The final hour, you see a lot of head fakes, maybe at 2:30, quarter to 3. You saw that a little bit yesterday, a sell-off, and a continuation of the trend. So I definitely agree with Dennis on those time frames. The only thing I would add would be, the futures is 6 p.m. open, even if you're not trading the futures, and as well as the 4 a.m. open, that 8 p.m. close too. Where was that closing print? Because a lot of times in a stock, that's when the equities close down. An institution will say, wow, this stock ABC's at $100 after hours. My target's 98. And they'll come in and they don't care about everyone that bought it at 100. They'll come in at 98 offer in the morning, and then it will repel off that high. So
there's just a
couple
what they say, right,
Joel?
You know what they say, right?
What?
just like the logo behind you, the early bird gets the worm, right?
Exactly.
So,
Exactly.
there you go.
So there's you go. And I'll turn it over to Rob on that.
Hey, Rob, I don't think we hear you right there. I think maybe you get
It's contagious, the mute trick.
I don't see him muted either. Oh, looks like we lost some audio on Rob. Rob, check your mic to see if it's connected. If not, just check your audio on Zoom there. There you go.
Sound check.
Got you. Looks like it just unplugged
Let me
a little
plug
bit.
it back
There you
in.
go.
I think it's better with the mic.
Ooh.
check?
There
No?
you go. There you go. We
Is that
got you.
better?
It took a second.
Okay.
Yep.
There you go.
So if the question is what's the best time frame
or
for
what
trading?
it's not the best time frame. What do you prefer, Rob?
Well, again, it depends on what strategy I'm involved in. So, for example, in January and February, I was holding and trading around core positions on a lot of SPACs. I probably had 60, 65 SPACs on. So the best time frame is ARCA pre, 1 a.m. Pacific time, 4 a.m. Eastern time.
Whew. Bright and
No,
early.
I mean, that's when that's when the news hit. So for example, if you had something hit, those stocks would gap up, significantly. And from that high, right when ARCA pre-opened, it was down all the way to the open from there. So it depends on the strategy.
I
Right
remember
now, currently,
that the SPACs gapping up at 4 a.m. I couldn't wake up at that time because I got the kids, but I remember those SPACs were out the same thing.
Dennis, I just stayed up.
Yeah, well, he's in Vancouver,
yeah.
so he can just stay up. He takes advantage of it. He watched some stuff. 1 o'clock in the morning only for him. It's 4 in the morning for me. That's a tough hour.
Put it this way, it's kind of like whack-a-mole. You go to the arcade and you play the whack-a-mole game, right? It's like these things just. The thing was, it was happening on a lot of stocks. People were just paying way too much. The retail traders were just like, no consideration, paying up for the opportunity, and that was happening in January through March to a large extent of this year. So it depends on what strategy, but right now, basket trading, the open in those first 2 hours, and in fact, Joel, the broadcast that we do sometimes interferes with me capturing those great reversals.
Yes.
It does. I put on
10:30.
stuff and it's like I might have some ETF spreads on and they reverse while we're on the show. So I don't know what we're going to do about that.
Well, what we're going to do is we're just going to have to go to a 24-hour PMP. We got Dennis and I out here, in the Eastern zone. We got Mitch out there in the mountain, and then we got you on the West Coast. Do we have anybody from Europe? We need some European coverage here.
Yeah,
and then we can go 24/7.
Yeah.
There you go. Looks
we
like
have even some in Singapore as well. So then we got the whole globe covered here. Yeah.
Hey, the chat's loving it, Rob. They're saying that some people are like, I need to hang out with Rob. I guess you got some late night birds in the chat. Not even the early morning birds, the late night birds.
I probably need, hair and makeup before I come on these shows because I really don't get any sleep, honestly, with all the things going on in my life. So 4 hours is a lot of sleep in a day for me. So there you go.
All right, let's go ahead and run through some more questions here. We're going to go to a little bit more one-liners on this.
Sure.
Do you still filter out stocks that have earnings? So do you pay attention to stocks that, I think the question was more of the day of earnings. Do you try to look at those stocks the day of earnings or prior to the earnings? And that's what you're looking for.
I'll field it just quick. So I trade earnings stocks. Like I said, I like the sympathy moves off of it. One thing to know is that going into the event, the technicals are almost meaningless, meaning when the company reports, I don't care. It means something to a certain extent, but if the company, has the prettiest chart in the whole world and they miss earnings and they guide down, that stock's going down no matter how good looking the chart was. But it's to a certain extent, you have to still be looking at the technicals because like in, examples where stocks have run straight up into the earnings report, well, the expectations are higher. So they're really going to have to beat. So the chart allows me to interpret the earnings report more efficiently. And that's where sometimes I will actually trade stocks into the earnings reports. A lot of times I like to think, okay, I think the stock has a really high bar. It's going to have trouble getting over that bar. Maybe I don't have the guts to actually short that stock into the report, but I might be ready on all the peers. So all of a sudden it does what I thought it was going to do, and it gaps down on the report like Nike the other day, when about a month ago. And then I'm ready to hit Foot Locker. I'm ready to hit the sympathy plays. Why is Foot Locker? We didn't talk about that relationship, but obviously Foot Locker and Nike are very correlated because Foot Locker's selling all the Nike shoes. So if Nike's got, production issues, if Nike's got things, that's going to hit Foot Locker and might hit it significantly. So again, looking at the peers, respecting the charts before, but not necessarily using it as an indicator for where the stock's going to go, but knowing if it's setting the bar higher or lower.
All right, let's go ahead and let's get into another question here. Going to knock out another one. So one of the things that was questioned here was the OPG. That was something that even really interested me. A lot of people in the chat probably don't know too much about order execution, of how a lot of brokerages are going more for an algorithm kind of to get your orders out there. So explain a little bit more about OPG and how you decide when to cut the trade, and where do you choose the price targets for that OPG?
Maybe Rob can probably go this one too. You want to go this one, Rob? It's something our traders use a lot.
Yeah, well, I mean, you might have it as LU, limit on open, or MU, market on open. But yeah, not all the platforms, offer, feature-rich stuff for you guys. I mean, it's just a problem. The bottom line is everybody's moved to, free commission models, and so things are more sort of gamified and less sort of professional features is what we look at it like. But it's really important to understand the implied open, where things are expected to open. So implied open or expected open. CNBC does publish it. Index ARB is another place where you can get your fair value and stuff as well. And so in order to do open successfully, it's not just based on yesterday's close, but what is a fair price to pay for this stock this morning? And I place my orders in relationship to that fair price. Doesn't mean I can't pay up or down, sell it lower than it's, but that's something that you choose. You elect to, set your envelopes for where you want to get involved. I mean, Dennis was talking about, an opportunity to short some of the chip makers or something like that based on Apple's news. It doesn't mean he puts his order 5% below where it closed the day before. He has to look at how the market is participating. And if the market's opening up, a lot of those bad stocks are actually going to open up with the market and then sell off from that point. So he's looking to capture that premium. So you have to be aware of what the market is actually implying in its change from its futures to the cash market. So that difference between where the futures are trading and where the cash market closed, that tells you, and you also can include fair value, what a fair price to pay for the stock is, right? Anything more to that question?
I just want to add just one thing, and this is something that I discussed with Dennis, early on in the Bright office. Is the opening print could be a very good indication for, depending on the stock, the high or low of the day. And if you look at stocks in strong uptrends, maybe it'll open up a little bit higher, maybe come back to that closing price and resume. And there's a lot of trading systems that are based on that opening price. And a lot of times it's not ever penetrated during the session. Now, if it's a volatile issue and there's earnings and everything, if you are wanting to short a stock and it opens up and it rallies, like, oh, I'm glad I didn't short the open. Perhaps take a look if it comes back down through the open, because the traders that did play it off the opening trade may either exit or reverse off that. So that's just a strategy for, using the opens for both ways. Sometimes it's just never seen. Just open up, boom, higher the entire day. or you get the reversal. I think if you go back and you look at some of your stocks in your long-term and short-term portfolio, you'll look back at that open and say, holy mackerel, I would take any heat from that. Now with all the third-party exchanges and stuff, and that frustrate, like I'm looking at a New York stock and someone sticks in a print at 9:29 and 59.99 seconds. It can mess things up, but there's more risk, but there's also more rewards off the.
I'm gonna. There's a question from Mr. Howard there.
Yeah, go ahead and touch
I'll add to that, Dennis, and that is he's got the right idea about good till canceled, and you're right that it doesn't automatically cancel if you're not filled. So that's the benefit of the OPG. But with the auction market, if you're in the deck, they're going to pull that back, and you're still going to get that benefit of that price improvement over your original order because you'll be in the queue. So they'll pull that back to accommodate sellers and buyers, and so you still participate. So if you don't have limit on open or market on open functionality, good till canceled could be adequate for you.
And you could, and you know what, just to your point, I mean, if you're only putting in a few orders, like at Bright Trading, we got some traders putting hundreds of orders in there. So the OPG is a real benefit because they don't forget those orders out there. So if you're only doing 2 or 3 orders, you just don't get filled, you just go cancel it then, So, and then it's like an OPG order. So you can just put a limit order, and if it doesn't get your price, but like you said, the biggest benefit to the open is like the auction system, where it's going to take all the orders that are in the queue, and you're willing to sell 25, that stock opens at 25.50, and you've got it, to the exchange, it'll open at 25.50. If you market pre-market, it's a different story. But if you're marking regular session only, you will get that better fill and you'll get that price improvement. So you don't necessarily need to have the OPG.
Right. I definitely think looks like we're going to have to do a presentation on only order execution. I think this is something that definitely a lot of traders are willing.
I think it would be good.
Wanting to learn from. A lot of traders are out there trying to figure out how to better execute orders. Either it is through direct routing, or if you want to go ahead and continue to use other kind of pay for order flow kind of systems. This is something that's talked about. We'll go definitely and touch that on the next event.
Yeah, just one thing too. I don't know if someone mentioned options trading and the orders. You could observe like when they'll wait to open those options. But, like they will, if it's a big move in a stock, they don't, like you get that opening print on the exchange. Well, they'll wait to get more, wait till it settles down a bit in liquidity. So if you have a level out there in an option and you want it, it either just stake it out there and, get it for the print, because a lot of times your order may dictate where the thing opens. They really wait for the price. So, important to get your orders in there.
All right, so I'm going to start combining a couple of questions here.
Sure.
So one question that we have is, and I'll throw it to Rob to give us an answer since it has to do with his system here. So there's Habib's talking about, can you mix trading, maybe trading pairs with stock odds all in one strategy, or is it more of a separate strategy?
No, I mean, there's a huge amount of overlap between trading pairs and trading baskets. So for example, you might curate a basket that has Coca-Cola, CCL, it could be AMD, a bunch of different things in there, and you have the opposite. You have Pepsi, you have RCL, you have Intel or whatever, one of the other chip makers, and so you could be long and short within the peer groups as baskets. And we have that data actually in stock odds as well. We have pairs in there. We also have the sector pairs so that you can compare everything with its ETF. And then we have every stock against the SPY as well. So you just get that standardization, that benchmark that you can use. And the experience that you're going to have, though, is if you're in short and long the peers, it's going to be statistically muted. So you're going to, not make as much right? But you won't lose as much. So your variance, the P&L swing of your account goes down substantially when you work within the peer groups. If you expand that out and you do what Dennis was talking about and you go, I'm going short financials today, or I'm going long financials and I'm shorting utilities or something like that, then you're going to, live or die by that discretion that you're choosing, right? And you're gonna have a chance to make more money. It's no different than the argument somebody says, well, I should have just all gone long today. I would have made a lot more money. My shorts got, kind of run over. True. If in hindsight, you could say I could have just been long, or I could have just been so short on some of those sell-off days. But we're here as career traders. And I think that everybody that's listening to this broadcast wants more than just a hobby out of this business. You want to make money. You want to either have a good side hustle, or you want a, full-on career, and you don't want to do anything else. Some of you guys just love trading so much that you wish it's the only thing you could do. And some of you are full-time. If you're going to get to that point where you earn more than $50,000 a year from trading, which hardly even cuts it as it is, but if you're going to get to that point, you have to do things that you can go through every market, up, down, sideways, the inside days, as well as the expanded trading range sessions. You have to be able to produce in all markets. And that doesn't mean that your profit is evenly distributed. Our profit sometimes clumps because of the types of days that there are. But I can make just as much on a totally quiet inside day as I can if we have a 700-point Dow move down or up. It doesn't necessarily mean it changes the equation. But historically, trading profits tend to clump. They're not evenly distributed. And one of the problems is that people take a missed day of opportunity into the next day, and they have regret that they missed stuff. So then in the inside day, they try to make something happen. They really, get all chopped up and whipsawed because they're living in yesterday when they should be living in the moment. They should be living in today.
Exactly, Rob. So what I always say about that is know when the river is flowing and know when the river is not, when the dam starts building up. I always say, the profits sometimes are going to come in waves. Sometimes you're going to have those big up waves. Learn how to control the down waves. And if you can control that, we'll definitely be moving forward. I like how the question was trying to combine variable approach using pairs trading, and then also, of course, focusing on stock odds, probability, using some correlation in your trading. That's what I like to do. I always like to combine variables. Of course, this is going to give you probably less trading opportunities when you combine variables, but it helps to go ahead and work your trading system to be a little bit more exact.
And to that point, historically, if I look back at all of our pair traders that I've rubbed shoulders with and helped educate and so on, the ones that were the top producers over the long sample traded around core positions, meaning that it wasn't just about single bet on a pair hoping that it works out. It was more the production side of the business that produced for them. So the ones that could earn money from the pair, not just win money, right? Not just be right on its outcome, but actually earn money. And that takes a little bit of a multi-tranche or multi-level or layer approach where, you might say, hey, I'm going to divide the capital that I want into this pair into two tranches, and I'm going to spread it out between them so that you might be holding your first layer and actually getting multiple trades on your second layer over and over again. That's the production that will earn you money over time. So there's many approaches like pair trading. I have a massive course in stock odds just on pair trading. I also have one on single stock trading, which is all about some of the price levels. What are the most meaningful? How do you use price levels? I'll give you an example. If a stock is breaking through the pivot and it has downward pressure, where is the first natural place for it to gravitate to? It would be S1, support 1. Same thing that's breaking up through its pivot. The natural target would be resistance 1. we go through all the different price levels and show you how to use it in terms of a positive expectation on your trades.
Excellent. So let's go ahead. We're going to get into Rob's presentation here.
One thing before Dennis runs away on me. One thing, Dennis.
I'm here.
There's a real opportunity in that TLT versus the utilities. So what happens is that if TLT is on the move and causes utilities to decline, which is normal, right? Because let's say, hey, let's shun the dividend paying stocks if we can get market, returns that are better. So you get that initial decline in the utilities, but here's the thing. When the TLT changes and reverses, the bang for your buck on those utility stocks, because now that they're discounted, they have even greater dividend yield than they had before.
Good point.
And those type of days, you just go to stock odds, you grab your most favored utility stocks and you put them in for the market open, and they just rip. So and you can have utilities and you can have those type of days where, hey, utilities are up, which are defensive, and technologies are up at the same time. You can have everything lift, and it was only because the dividend yields became so attractive on the utilities that the funds have gone in.
All right,
so I just wanted to throw that out. It hit
point.
me when you were talking.
Yeah, that's a good point.
Definitely. Okay. We're going to go ahead and get into Rob's presentation here. We'll get back to some more questions. I'm definitely have all these listed. We're actually going to send these out also. I'll definitely get that sent out in an email so that when you go back and listen to the video, if you wanted to match the question with the answer, of course you can do so. Let's go ahead. Let's get into Rob. Rob's going to talk here, take on over the stock odds. So if you want to get the odds in your favor, my man right here, Rob, take on over.
Thank you. Appreciate it. So there's some overlap between Dennis and I, obviously. I'm going to use his disclaimer as my disclaimer as well. And everything that we're trying to do is education and increase probability literacy. So it's not about absolutes. I mean, you could have the best data in the world and you could take a trade and something else might interfere with it. Just like with swing trading, you may have had some great swing trades on that you did everything right. And yet the market had other ideas for your life and the trade didn't work out. And so that's part of the reason that we like to be hedged. It's part of the reason that we like to sort of try to take the market out as much as possible. But there's some overlap. I'm going to get into the predictors part of it later on. I'm going to actually build a little bit on Dennis's sympathy plays. And I think you'll find that really interesting where we're going with this. But first, we'll run through some of this stuff here. Let's see here if we can get this to work. Okay, so the market moves first. An overnight pre-market gap on a stock or index may have market participants scrambling to adjust for the ripple effect of what just happened. Not all gets efficiently adjusted. And the more relationships you monitor, the more informed you can be. So trading using an incremental approach versus all in at one price. I mean, it's a little different if you're trading just from the open to the close, or you're trying to just trade for the open and get some anomalies. You might be sort of full position, but in other relationships, you can use an incremental approach and it can really work out well, similar to what I just mentioned in the Q&A time, where you might have, a 2-layer model or a 3-layer model and trade around a core position. Multi-layer approach, okay? And likewise, when markets move intraday, market participants are adjusting the next day. Important point we'll talk about more later. Here's some of the predictors that we use. Dennis mentioned a few. So basically the market ETFs, US dollar, the euro dollar, the VIX, emerging markets ETFs can be sometimes really good indicators. Say the large caps in China, FXI, gold, natural gas, and then the other industry ETFs, like those are more specific versus the sector ETFs. Value versus growth ETFs can be helpful. and special thematic ETFs that have some volume. You know, Kathy Woods, she's got 5 or 6 of them that can be reasonable indicators as well for risk on or risk off. So that's really what we want to ask ourselves the question every morning is, you know, is it a risk on day or a risk off day? And so we do homework the day before, preparing all the stocks that we want to trade. In the morning, there may be no changes. It might be just rolling it out just as planned, or there might be a bit of capital focused areas, you know, that we adjust for. Some information on ETFs. There's 222 ETFs that have an average daily volume of over 1 million shares. So a lot of people say, well, you know, I don't know what to, you know, choose on my short side of my pairs or, you know, basket trading. I don't want to really, you know, do a lot of short stocks because they seem to, you know, just everything always goes up. You might want to look in the area of the ETFs. There's so many combinations of things that you can do, and 222 of them, you know, have an average volume of over 1 million shares, and they're going to be less impacted by a merger event or any special news on a stock because, again, they're statistically muted. Now, you have to know whether they're equal weight or whether they're market cap weighted type ETFs. But of those, there's 25 of them that are triple leverage and 18 are double leverage. And then there's 87 ETFs that have an average daily volume between 500,000 and 1 million shares a day. And then below that, there's 2,150 ETFs that have less than 500K average daily volume. So some pairs can be created from the 200K and up average daily volume. So you can create ETF pairs based on, you know, a really liquid ETF, and then, you know, even 1, 2, or 3 kind of a miniature basket of smaller ETFs that tend to follow or have some lag or have some mean reverting nature. So there's plenty of ETFs to explore around. And also you want to dial into, like, for example, Apple. How many ETFs is it really a member of, and what's the weighting in those ETFs? You know, same thing with Microsoft or any of the other big cap stocks. Like, how many ETFs do they cover? Like, it's good to do a little bit of homework in this area if you want to trade these things. So many relationships are efficient, and we'd be best traded utilizing automation if you're trading the spread. So sometimes some of these things are so efficient, there's no other way to trade them. You know, humans just can't respond quick enough. But an efficient pair, like one of those that is automated trading, can be used for directional trading, which we call crutch trading. And Dennis alluded to that briefly. Other relationships can be harnessed for spread trading that are not as efficient. So these are more like for directional trades or for informational purposes, right? So here's an example of a very efficient, it's XLU versus VPU, Vanguard's utility ETF. So you got a sector ETF and another curated ETF by Vanguard. And you can see how absolutely efficient that pair is. I did a differential spread on it, so it's, you know, it's moving about 10 cents back and forth throughout the day. There can be a lot of these ETFs have opening anomalies. They, you know, can be quite funky at the open and not perfectly efficient, because normally some of the algorithms don't really get started until after a few minutes after the open. So just remember that. But that's the example of something that's traded on an automated basis. And, you know, I know plenty of traders that have created automated, you know, utilities to do this, and it can work for them. But you can also use crutch trading with those particular efficient spreads. They work really well because you're not putting the entire pair on unless you need to hedge yourself. So crutch trading is not based on human intuition or prediction. it's always about the quality of your advantage. Okay, really important statement. The quality of your advantage or edge. It's a crutch trade is taken as a result of something. Where I've seen people make the biggest mistakes is based on looking at an opportunity and then extrapolating out or predicting on a human basis where they think that the thing is going to go. So they take the crutch trade, and invariably they're generally wrong right away because they're trying to predict. And there's a better approach. It's taken as a result of something, either discount or premium or ATR expansion or gaps, things like that. The key is the hard side first, right? So what do I mean by that? If the market is weak and the stock is sliding, most stocks sliding with the market, and in this case, the two stocks of this relationship, this efficient relationship, are both sliding. Then I showed you, Verizon and AT&T both sliding together. So it wouldn't be too difficult to recognize that the market's weak and the stocks are sliding, or if the market was strong, they could still be in a weak group and be weak stocks. But they're sliding, so you'd want to do the short side first. And if the market is strong and the stock is rallying, long side first. If the stocks are illiquid, you probably want to do the illiquid side first and then the most liquid stock second, if you needed to hedge. And also this lead lag relationship, if there is, truly one that tends to follow the other one, then the lagger would be the one that you would kind of do first by watching the leader. And you also have to be aware of the bid-ask spread. If one stock has, a bigger spread between the bid and the offer than the other one, the one that has the bigger spread is more difficult to do. So the hard side has a number of implications. And when you're doing this business, just think the quality of your spread number, which is the core decision maker. So in order to be an effective crutch trader, you still want to watch a spread number. So if you can create that in your platform, or you can create that through a spreadsheet, anything to sort of give you, and if you can't, you just, watch the stocks and have, your calculation on differential, maybe percentage change or whatever. I don't know what custom features you can create in your platform, but we watch it through spreadsheets. So we see, when the spread number has moved to a discount. And the way it works is, imagine both stocks sliding down and they get to around an ATR. An ATR is average true range. So basically the true range and over multiple days, the standard is 14 days. So let's just say it's a measuring stick of volatility. So it's moved down a full ATR. At that point, you look at the opportunity. If the spread number is discounted, then stock A would be the one you'd want to buy down a full ATR. And you're not buying, or you're not shorting stock B. That's your crutch. That's your hedge. That's what you're going to lean on if you're wrong. That's what you're going to, use as a safety net here. And by the fact that the spread number is nicely discounted, if you had to lock the spread on, the odds are that it would have some retracement or some elasticity because it's a highly correlated pair. It's a highly efficient pair. So if it's already discounted and you put the spread on, the odds are that it's going to come back in somewhat. So that changes it from, just a win or lose situation to a win or wash. So crutch trading is called that because you're able to hedge if you're wrong, but you still want the outcome to be either you win on your crutch trade or you win on your hedge trade, or worst case, that nothing happens afterwards and you go, well, okay, I don't want to babysit this thing all day. I'll just move on to other things. And you just wash the trade, meaning you just get out pretty much break even. But this enables you to take a naked trade without the implications of being so exposed to having to be perfectly right or have the market go your way or whatever. You've got your safety net, you've got your crutch standing by. Okay? So again, spread number is your core decision maker. So if I'm looking to do a crutch trade, I'm watching the spread number to see if it gets a discounted, and I've already kind of seen which way the stocks are traveling. And if I can measure the ATR, say the stock is down 100% of its ATR, I mean, I've got a lot of things working for me for an advantage trade. Then there's money flow relationships. So this is XLF versus, oh, sorry, that should have said XLK, XLF, or this is XLF and XLU, sorry, XLF and XLU. So this is more of a money flow relationship. It's, it's going to be when the TLT moves or when there's some other information on the group, maybe like we had bank earnings and things, and they're kind of moving directionally. It gives you some opportunity for expansion and contraction as well as directional flow. Or, like I said, you can use all of these types of spread charts simply for information. Trading View is a much, lower cost method of watching spreads than, say, getting e-signal, just FYI. And, you can see spreads for the daily for free. You have to pay a little bit for the ongoing minute by minute or tick by tick if you want. So you can watch spreads. Maybe your platform has it. Some trading platforms have the ability to watch pair charts. So this is another relationship, obviously the Qs and the SPY. Many opportunities surrounding trading ETFs and relationships. Again, some directionally and some for mean reversion. But it's important to watch this particular one because you got the NASDAQ 100 and then the S&P 500. And there are some volatility differences. So I look at ATR as a percentage of price. So the ATR is $5.38 for the Qs, and it's $5.66 for the SPY. So you'd think, oh, well, okay, SPY is more volatile. No, ATR as a percentage of price is only $1.27 versus $1.46. Then if you look at the other volatility metrics, Qs are much higher. And recently we had all the impact in the tech area, so things changed that way too. You got to look at their holdings by weight. As I mentioned earlier, the Qs has Apple at 10.9%, Microsoft at 10.44%, Amazon at 7.67%, whereas the SPY has Microsoft at only 6%, Apple at 5.96%, Amazon at 3.85%. So you've got almost double the weightings of those three stocks in the Qs versus the SPY. Again, if you're going to trade these relationships, spend a little bit of time in the research so that you're an informed trader, right? And understand what makes it move. What are the key ingredients that are going to make it move? Obviously, it's going to move based on everything that's going on, but some of this exposure here at double, even the Googles, right? Double what they are with the S&P 500. The SPY, it's going to change the outcome, and that's what makes it more volatile. So here was a trade that I actually took on Friday, just after Joel and I finished our chat that we have every day there. So I got some of this move up here off of this kind of pivotal change. So that was Qs versus the SPY. So the formula for that, and then you can use this formula for any of your pairs. So first, just take the ratio of the two things and see what the ratio number is, and then use that to create your what we call a factor adjusted differential spread. Now, you can create a spread based on the ATR differences. You can create a spread based on beta weighted. You can just, keep it as a ratio if you want to watch that. But I find it easier to trade something when I see the differential spread, because it mimics more the actual movement like a stock would have. So, I got in down here and had a nice move up, and I can see how much it's moving dollar wise. So the way it would work is whatever position size you have on the one side of the equation. So if this is 1.21, so let's say 121 shares of Qs versus 100 shares of SPY, I would make 100 times the amount of movement that happens in the spread. Okay, so again, if you always do it this way, something to one, and I like to have the lower price stock as the first symbol in my pair, because then I can use something greater than 1 to 1. I can either do 1 to 1 or something greater than 1 to 1. And then again, every penny or every dollar that the spread moves, you make that amount times your position size on the one side of the equation. So again, it's a factor adjusted differential spread. A straight differential would be just A minus B, right? Or Q's minus the SPY. But I'm adjusting it for a factor. And we do all kinds of creative things, like, we'll put a couple symbols against, one, or we'll add a constant, like you do in risk arbitrage. You add a constant, a cash value, anything to advantage us in the sense of, how the thing actually behaves or what it's related to. You can do things like you can have three stocks that are, highly weighted within a sector, just against the sector. And you can do a special formula to get it really a flat, more of a flat line. And then you look for the standard deviation around that flat line, right? Standard deviation works good if you have static or stationary data. It doesn't work as well when things are moving all over. That's why you have a challenge with just trading off Bollinger Bands. The world would be perfect if you could just use Bollinger Bands on completely stationary data, but you can't. Okay, so just remember that it doesn't have to mean revert. It's just you're looking for volatility reversals, and that was an example of one. There's plenty. You can look back at the intraday charts, and also in the pre-market, this yellow area here is the pre-market. It already gives you some indication of the sentiment. This is really important. That's why I'm saying, even if you don't want to trade these spreads, just having them to watch, right? Just watching them gives you a ton of information. Okay. Basket trading. So a long basket is 2 or more stocks taken long. And yes, you can trade without hedging if you like. A short basket is 2 or more stocks taken short. And yes, you can trade naked. Making a variety of bets provides diversification. We all know how hard it is to be right on a single selection. Each bet needs to have a positive expectation so that it's not a gamble. And if you do hedge, the perfect outcome would be to have each long stock move up from your entry price and each short stock move down. And more probable is that some do not perform as intended, right? You're making money on the relative performance between your long dollars and short dollars, and that's really the key. Okay. Checking on time. Just let me know, Mitch, how I'm doing here. Okay, compiling baskets. There are dozens of input criteria that can be used when selecting symbols to include in your baskets. Continuation of performance, so relative strength. Reversals from extended moves. So this is looking for mean reversion, and mean reversion has been a huge opportunity over many, many years. But people don't often understand, what contributes to mean reversion or how powerful it can be. An example would be in some of the greatest moves upward in the market that we've seen. money is often made from the short side. That sounds like weird. How can I make money from the short side? Well, because people pay way too much for the open, for the opportunity, for the, hey, this is going to be great. You know, somebody was yakking about this particular stock or these groups of stocks the other night, and you know, I'm gonna trade these. I'm gonna buy these tomorrow, right at the open. I'm gonna buy them, and so they often pay way too much, which is why we stress, you know, choosing the price of your participation and knowing what's opening, you know, in a distorted fashion can give you some real advantages. And there's that element of mean reversion. Technicals or indicator based, fundamentals, news, or macro catalysts can all be used for compiling baskets. Relational insights, small cap versus large cap, high volatility versus low volatility. So this comes into the risk on, you know, you want to be long volatility and you want to be short the boring stuff. So if you compile a basket, you're going to be still somewhat insulated to market shocks, like, you know, a dirty bomb goes off in some city and the market just starts crashing. Well, you're going to probably lose money just because you have long volatility, but you're still going to be also fairly insulated in that you won't lose as much, and it'll give you some time actually to start to unwind some things if you needed to. But that market neutrality, you know, is best, but you can also choose to be exposed in a risk on or risk off environment. So risk on means, you know, they want to go out and buy the speculative names, and risk off means it's more defensive and more the boring stuff and things like that. And in October, you saw some of that. There was some movement into the Dow components and some selling of the NASDAQ stuff, okay? Again, defensive names versus speculative names. These are all ways of compiling baskets. So ETFs, we looked at a composition of the Qs and a composition, the holdings in the SPY. Are those not baskets? Those are baskets. Every ETF that is made up of stocks is essentially a basket. You know, you can create your own motifs, you can create your own baskets that give you an advantage. I mean, someone designed those ETFs for a purpose, right? Now, even in program trading, that was, you know, really in the focus for so many years. Every morning, firms would design the baskets that would best represent when the futures went to a premium over the cash. They would buy that basket of long stocks and sell the futures. And then when the things went to a discount, they would buy the futures and short the so they didn't have the same stocks in each basket. The basket of long stocks to arbitrage the futures against the cash was completely different than the short basket. So when the futures went to a discount, the sell program would come on. When the futures went to a premium, the buy program would come on. That would mean they would buy the cash or the stocks that they had in the basket and sell the futures. So that was massive. I remember back even in 2000 and let's say, you know, 11, 12, that in August, for example, 70 to 75% of all the volume in the month of August was just program trading. I mean, it was, you know, not many other people around really taking vacation time and stuff. But you know, it's changed now where there's so many different algorithms and there's high frequency and things like that that has really risen. But you get the idea that basket trading isn't something that we created. It's been around for a lot of years. But you, the trader, have the opportunity to create strategic baskets that represent the type of day that you want. I prepare in advance the day before, and then I make adjustments in the morning if necessary. You could just get up early. If you live on the East Coast, it's not so bad. You get up and do your homework that morning and pick, you know, based on what's actually happening. So type of hedge baskets. So you can have a compilation of long stocks versus a compilation of short. You can be long stocks versus ETF. Like you can just be long a whole bunch of stocks. And here's an example for you. So the market's opening down huge. Let's say the Dow's opening down 400 or 500 points. It's a really bad day. I might just cancel my shorts and not send any shorts into the market for the OPG. I'll just put out those longs, and I'll have the SPY standing by to really quickly hedge the entire basket just with SPY in case it opens down and doesn't give you that bounce, right? So then you want to hedge off immediately. But a lot of times we'll open down and stocks will just start ripping back. Well, if you have a basket of longs, that's much different than trying to pick the one stock that's going to be the one that bounces. You might get lucky, you might get it right, but if you have your capital spread out so that you're not exposed, in a concentrated fashion to just one idea, you've got exposure on an aggregate basis, you can just quickly hedge with the SPY everything, and you're protected in case the market doesn't really want to bounce. So choices for hedging, we went through some of, you could do sectors, you could do Qs, you could do Russell, IWM, you could do the diamonds, DIA, or the SPY is pretty good coverage overall. You can be long stocks and clusters versus a sector or industry ETF short. You can be short stocks versus ETF long. You can do a bunch of mixture stuff where you do some stocks from one group and their sector ETF short. Maybe on another group, you do some short stocks and then the sector ETF long. So you can really mix it up if you want. You can just do ETFs versus ETFs. And position sizing, you have some choices. You can do equal dollars, just a certain amount of dollar per position. You can do beta balanced if you want. Historical volatility balanced, or a mix between HV and beta if you want. Or you can do ATR balanced, which is, I would use the ATR as a percentage of price. So that would mean that, you might not be perfect dollars for dollars on the Qs. You could change that with Qs versus SPY. You could change that to have less dollars on the Qs because they're more volatile. But you get to choose, and nobody can tell you that this is exactly the way that you have to do it. But you have to understand what your methodology is and why you would do something. That's so key, right? So approaches to executing, there's obviously the pre-market opportunities, and there can be a lot of anomalies pre-market, right? You have to factor in, though, that implied open, the news, other conditions, make sure it's strategic discount or premium. And so for the open, you can do limit on open or market on open. Having a trading platform or broker that has feature rich. So actually within Bright, we don't have to specifically send to the market center. If we use Goldman's smart order router, it does automatically send it to the right venue for the market center open. So you can just use one order type. So sending orders to the API via spreadsheet or with wave or batch functionality. And again, Interactive Brokers Pro has more functionality than some of the other free retail brokers. Open to close or open to profit targets or anomaly to close. So again, you could have a list that you put on the open, and then you start taking things off as they mature, half or a full ATR, as they reach your profit targets individually as a stock. You can always lock in some profits. So you can do a watch list. You don't have to execute at the open at all. You could just say, I've curated some information from stock odds. I've got my baskets. I'm going to put them into the watch list category. And if they drop to a level, if they move a percentage, you can create tons of if-then statements around a watch list. So it's your choice. And that's a great way to start and practice. You can actually run various models in Google Sheets is a really good way to do it. That's just sort of independent, not tied to your broker. You could just run a bunch of different models and see how they did from the open to close or how they do throughout the day. A lot of different functionality you can do. You can create spreads in there, stuff like that. So Google Sheets is pretty helpful for running some models that are, you could check it on your phone when you're away from your platform and all kinds of things. So you know, the stock drops from your list, drops a half or a full ATR after the open, and then you go, oh man, that was highly probable that this was going to perform okay for the day, but it's given me this discount. So you get that sometimes. It doesn't just go in a straight line from the open to the close, and guess what? You get to make money. Sometimes you have an expected value. You have what's called a theoretical value. If you guys have watched the movie 21, or you know anything about Bob Bright's career in counting cards, you know that he had to base everything not on in terms of what happened at the table, but what his theoretical was. I can't stress this enough. A trader needs to trade with a theoretical expectation. That's a probability-based, you know, formula that says, I have this edge, it's theoretical, and I will make as many bets as I can, because over a large sample, my theoretical will pay off. It will turn into actual. And that's what happened in card counting. They had a theoretical advantage over the house of maybe 1% or 1.5%. And as they played more hands with that edge, it turned into money. Okay, but you didn't win every hand. You can take the approach of going to seasonality. And here's an example. So mid-month seasonality that we're in currently right now, it says that financials are favored. Well, first of all, if we look at the whole month here, it says that financials should outperform the SPY for the month of October by more than double. So that's good information. It doesn't mean it has to happen. It means that is what has happened over the last 8 to 10 years. We've seen this phenomena of financials doing really well in October, even better than the S&P 500. Most people think that October is a down month. No, it's a volatile month, but on average, it actually performs reasonably well, almost you know, a little more than 0.75%. So what I do is I put in my different symbols into the stock traders or stock odds seasonality almanac, and I see what they're expected to do. Some are expected to go down for October. Some are expected to go up for October. Some really perform well. You know, I'll be really looking at the Russell going into November, the IWM, because it's expected to perform at 5.1 or 5.5%, if I remember correctly, way above what the SPY's going to be doing. And that's typical for November for the Russell. So hopefully the Russell stays discounted or performing not as well as the other markets, because come November, it could give us a real advantage. I get to plan for November exactly the symbols that I want to be in, that I want to focus on, the ETFs and the stocks. Yeah, just
all right,
let me know here when you want me to
go ahead, Rob, if you could just finish up here in the next couple of minutes so that we can move on to the next.
Okay, sounds good. So so this insight of mid-month seasonality really assists in you know, going into stock odds and looking for advantaged financials. So let's see here. Vantage financials. I think I had some of them up here. So you know, I curated that list for this mid-month seasonality for some of the financials. JP Morgan came up, BRO came up, and so we've been trading some of these long, AIG, MMC. So just gives you an idea. Those were from stock odds to say that these stocks would, in the financial sector, would perform really well. So if I see that, I'm not looking for shorts in the financials. I'm looking for advantaged longs that I can create baskets from to trade open to close, or some of you may want to trade them in a swing trade fashion against other things or against other ETFs. So with that, I can wrap up for the moment. I got lots more to share later.
Hopping on here, let's go ahead and bring back Mr. Joel Elkanan. We're going to get into price observations and deriving your own trading levels. You guys let me know in the chat, how's it been going? I turned off my light a little bit there because I was paying attention to Rob so much that I didn't want the light bothering my eyes. I was focusing in there, learning myself. So I have already a page of notes. I'm sure you guys probably have a couple of pages out there. So I'm going to go ahead and let Joel take over and let us know, deriving your own trading levels. Go ahead and
yeah,
Joel.
thanks for having me. One thing that I've noticed listening to the presentations with Rob and Dennis is where the consistencies are. And I think that's one thing when, Dennis and I are on the show, we try and do that too. But let's get a little bit more into, the nuts and bolts of technical analysis, right? And deriving your own levels. And it's just, keep it simple, silly is really what I try and do and what I try and emphasize. Now, what I'm going to do here is I'm going to show you just a couple things that I like to use as, when I'm doing my levels, and they're not anything special here. They're available on the public here. Let me see. Let me bring up the right one here. And this is one thing I like to go to is bar chart, barchart.com. And what I do is I'm going to make sure I'm showing the right thing here. Yep. Is what I do is, the thing that I really like what I get from this is, the S&Ps have a different way of settling. It's actually the last 30 seconds.
Just want to interrupt here, Joel. You just had the correct one on and you just put on your YouTube one. So go back to the bar chart one.
Okay. Let me go back to the bar chart one. Okay. Is that correct?
I'm still seeing YouTube, the YouTube live stream.
All right. Let me stop the share. Share again. And
You gotta pick your screen, it'll pop up.
I got it. Yeah. Okay. Tell me when you got the bar chart up.
They got
there.
the behind the scenes look.
There you go. There you go. We got it.
Everybody got the behind the scenes look.
Yeah,
like
don't
that.
look at that. Okay, it just for this, I like to, obviously the closing price is very important, but the thing that to me is most important for the stocks and for the futures is like the average daily range, the average true range, the 9-day true range. And what I'm using this for is just, projections of highs and lows, like when Rob talks about probabilities, right? And what's the average expected range in something. And if it gets to that point, I like to use that as targets because it's going to give you targets. And it's also, if it coincides with other levels, it's a good indicator as well. So that's bar chart here. Let me stop the share again and then bring up another thing that I like to use. And this is just a pretty simple thing. And Rob talks about the pivot points, and everyone has their own kind of pivot points. And this is just a simple thing that I like to use. It's let me pull it up here. It's the pivot point formula. And I'm going to share the right screen here and move it over here, move it into the middle. And the pivot point formula is at pivotpointcalculator.com. And what you have to do with that is you just
Joel, sorry to
do you have a
interrupt here.
fan on, Joel?
Do you have the fan on or the mic?
There's
There
something
go.
hitting your mic. Okay.
There you go. We got it now. Appreciate it.
Okay. And are you seeing the pivot point calculator now, guys, or not?
I think my charts are still up, the presentation. Go ahead and share again.
Okay. Okay, we got it in screen 2 here. Okay, this is the pivot point calculator. And I know people have different ways of calculating their pivot points, but this is just a simple formula that you can use. and it allows you to just put in the input from the day. The open is not as important in this calculation, but the high, the low, and the close. And really, the primary thing I pay attention to is what is the actual daily pivot for the day. And then what I look for in that is I try to see if there's any levels coinciding with that pivot point, and then that gives it more credence. So, and then the other thing that I just for general overall market trading here, and this is I talk a lot about the S&P 500 index. This is something that I like to keep an eye on frequently to see what the top components are. If you are looking at the top components in the index, you can see it here. Actually, Microsoft has now overtaken Apple. But if you go back, you go through these top 11 components, I like to include the two Googles. You're having like 25, 20, 26% of the market. So that's something that I always keep up on my screen just to look at where those, those main stocks are going, because it's going to, if all those stocks are strongly in the green, or a majority of them are, it's going to give you a pretty good indication. It's also important to follow this. I mean, when Dennis and I started following this back in the day, Exxon Mobil was the top component. And then, for a while, GE was up there, and IBM. And now if things evolved, you can see that, now it's dominated by tech stocks, all the way down until you get to Berkshire Hathaway. So that just shows you when I'm S&P centric, this is what I'm looking at. This is the top components in the index. Also, when I talk about the keep it simple, simple, silly method, I'm looking at the pivot points that I talked about. I'm talking about, double tops and triple tops, and double bottoms and triple bottoms. Also, multiple closes in the same area. And I'll give some illustrations of that where, you're looking at the closes. A lot of volume is done on the close. A lot of the institutions are marked on that. So that's an important thing. People ask me about volume. I think volume is important. I don't keep it up on these charts. I'm more price sensitive. I think when I paid attention to most to volume, and it's really been applying to some of these, meme stocks. You see tremendous runs, or you see the first day of a run, you'll see like halfway decent volume. Then you'll see the second day where a lot of new people are just piling into the stock, and it has a continuation move. But once the volume, this is the time I pay attention to volume most, is once the volume starts to slow down, okay? Then you're looking like, okay, well, there's plenty, the boat is plenty loaded. Where are the buyers going to come from the following day? So we can illustrate that when during the pre-market prep show, when we're looking for turns in the stock that are important. But moving over here to the 4-chart setup, I know we get different debates about why do you have this, or why do you use TradeStation. This is what I want to illustrate. The upper left is the 15-minute chart here. And I like to incorporate the after hours and the pre-market trading. Let me make sure I get this up here. Sure.
You're good. You're good.
Good on a chart? Okay.
Yeah.
I'm just trying to
Yeah,
find
we don't have your
stuff.
charts up, but we have the charts right there. We could see all 4 charts, so you can go
Okay.
explaining them.
Okay. All right. So what I'm looking for in these charts, and just going back to an example the other day, was with Domino's Pizza. You have some stocks that report after hours, right? So when I have the 15-minute chart, I can see how the stock reacts to the after hours action. Then you also have stocks, so that's a 15-minute time frame. So that will give me up to the 8 p.m. close here. Right. When you go into the 60-minute chart, then that starts to incorporate the pre-market action that starts at 4 a.m. So when the upper left is the 15-minute chart, you get more of the shorter term. The 60-minute chart incorporates the pre-market as well as the after hours. Then on the right, upper right, I have the daily chart. And the reason I have the daily chart up is I'm looking to see if some of the pre-market levels coincide with some daily levels. So that doesn't always happen. But when you talk about large orders and large, institutions that are trading things, their orders will be out a lot of times during the pre-market, the after hours, but they'll stick with their those levels, during the regular session. I just wanted to give one example here, going back. This is going back a while when you had the big gap down in Clorox. And I remember talking about this with Dennis and looking at some of the monthly charts. And, there was some monthly levels at 155 and had orders out that day to try and purchase shares at that area. But if you go back and you look at the pre-market action from that day, the pre-market low was right in that same area. So the buyers that you had out there in the pre-market were out there also during the regular session. I have a better example of this on the sell side, and this is going back a couple days in SoFi, and this is more for your shorter term traders that are trying to gauge whether or not the pre-market action is going to have follow through into the regular session. This is a day where the color changes here. This is representing all the trading action right up until 9:39, right? So you were trading here right at the highs of the pre-market session. For this one, the pre-market high was 1981. You hit that right off the open, right? And then you ended up having a pretty good sell-off in the day. So if you're a short-term trader and you're looking to see, if the pre-markets, if you're looking for some follow-through, then jot down those pre-market highs and lows and then have them available, see if it coincides perfectly or you get a follow-through move. Some other stocks that just taking this example of the pre-market action, I want to go to Facebook the other day. The stock has been in the news quite a bit.
Can you reshare charts there for me, Joe?
Yep. Going back to Facebook the other day, I'm talking about the price action here when, it had, this is when the whistleblower was testifying. You had a lot of, some people are obviously trying to pick a bottom in this one at 340. This is when the whistleblower started to testify, right? So you broke through, you had trap buyers on the open here. And that ended up, even though it had a much lower open, the high for the session still ended up being near that much lower open. So I don't have the pre-market activity from that day, but it's just using the charts. Naturally you were thinking, wow, it's been holding 340. You got a much lower open, another opportunity. But in this way, if you were using the open and the follow through from the open, perhaps it could have avoided along that day in Facebook. Going to another example of the pre-market trading in space and how you could have used that as an indicator. This was right around when they did their launch, and there was their latest launch. There was a lot of hoopla surrounding it. You got a lot of activity in the after hours trading. Traded actually that day, it traded up to 59.22. People were really excited about the launch over the weekend. But if you were looking at that, you say, okay, that could be a target. If it doesn't get there, what am I going to refer to? I'm going to refer to a daily level. And you had a daily level, you had a high at 53.60. Even though that day it traded a little bit higher, the open that day was very close to that level, and it usually helped you, get some follow through on that. kind of jumping around here, but I just wanted to uh, go back as far as the opens go and the closes. Going into the opens here, I mean, this is a good example of a stock trending higher. Upstart it's had a really nice recent run. But if you were looking at this, this move, and you were looking at the opens in relation to the previous day's high, or not even seeing the close, you could see, you had the higher open, just kissed under the close, continuation. The same day, the 2-day, the 3-day, and the continuation move. Now, one thing that I wanted to cover too was the importance of closes. And closes are very important because, as I mentioned before, that's where institutions are marked on their positions and they're looking long term. Just using Moderna as example here, I remember walking this through with some of the members of PreMarket Prep Plus, and there was a lot of expectation for this stock. Getting this close to 500. Are we going to trade over 500? And what I was trying to note, the activity in this was not so much the all-time high, but what I was emphasizing in this point is, what was the all-time closing high? What was the highest that stocks ever traded? Where's the highest people have ever been marked? And on the 9th, you had a high of 493.76, and you posted your all-time closing high that day at 484.47. Now the next day you did get a pop up. You did take out the previous day's high, and you did make a higher all-time high. But if you would have looked at, if you would have kept your focused number, that all-time closing high for the day, it settled a good 30 or almost 30 points below that. 384.47 marked the all-time high, and then the all-time closing high was, like I said, almost 30 points lower. And then it actually never saw that close at 456.78 again until it had the extended sell-offs. Also, just like the importance of the closes is, the momentum going in, stocks that, are trending, towards the end of the day, closing near the upper portion of the range. That will show that also for the futures, that will show continued strength for the following session. So talked about the opens with you guys, and talked about the closes. There's just one other thing that I wanted to bring up to you as far as kind of jump around. Thank you, Mitch. Is the opens, and a lot of times this is more related to New York stocks, and I can give you an example here. Going back with a stock like Ford, the trade's just a ton of volume. This is going back a couple weeks ago, where it was trading sharply up in the pre-market trading. We had noticed a lot preponderance of orders in the book at the 1550 area. You saw your pre-market high at 1551. So you knew you would need a lot of, I believe this was might have been on an earnings day. You would need a preponderance of buyers to take out that size. And Dennis does great at noting the size in the book and see if it can take it out. Well, the intraday high was below that pre-market high and ended up having a pretty good sell-off. So that's when we talk about the volume and what's going on in the pre-market trading. Is the volume enough to overcome what's in the New York book? So kind of jumped around from the closes to the opens, but just going back, to the levels as far as the pivot point formulas and the daily highs and lows. The more confluence, the more you can get areas coinciding at the same place with the levels, the more emphasis that you can put on them.
All right, I'm gonna go ahead and hopping in. All right. So as you guys see, deriving your own trading levels, one of the things that I would clearly say that Joel does really well is exactly what his acronym says there. And that's KISS. Of course, guys, keep it simple, silly, not stupid, but silly there. Definitely, I appreciated that. And the KISS method, I can say, and if you guys have been watching pre-market prep, you guys have definitely seen those levels hold before. All right, let's go ahead. Let's shift on over to Dennis Dick. As you guys know, the one, the only. Let's get into that triple D. What do you got for us now?
I'm gonna start sharing my screen here right now. Let's just make sure we share the right screen. We're gonna share this one here. And you should see my presentation here now.
We got it.
Arbitrage and the social media effect. So it's actually two separate topics, but they kind of go together too, because impressively enough, in my 21 years, I have not seen arbitrage relationships get blown out by social media, but I have seen it happen in the last year. So we are always learning in this market environment. So we're going to talk different types of arbitrage. Again, sticking with the relationship, theme here that Ra's been talking about, Joel's been touching on. And we're going to jump into just arbitrage and basic different types of arbitrage. So let's do it. Again, all the information you see, informational purposes only. Consult your own investment advisor before making any trading or investment decisions. So today we are going to talk in the next 30 minutes about types of arbitrage. We're going to talk risk arbitrage. We're going to talk social media impacts on not only individual stocks, but also on arbitrage as well. We're going to talk high short interest stocks. A lot of social media loves high short interest stocks. So let's talk about it and talk about different edges and talk about, and talk about these. And let's jump right into it. So there's different types of arbitrage. Some of these you're going to be able to participate in. Others, it's going to be difficult unless you're at a company like Bright Trading, but some of them you can participate on a retail level. So I want to teach you. So share class arbitrage. We're going to go into all of these. Intermarket arbitrage. So share class arbitrage we'll talk about in a second. Intermarket arbitrage, just stocks that are interlisted. So for example, there's about 100 companies that are on the Toronto Stock Exchange, also on New York and the NASDAQ. There's a pile of European companies that trade as ADRs over here, basically just following those prices. Those prices are kept in line by high frequency traders, and it's tough to participate in that, but we'll talk about that in a second. ETF arbitrage, which Rob has talked about, the ETF effects, and we're going to dive into that in a little more detail. SPACs and warrants, and risk arbitrage, which is merger deals. So let's jump into it. So share class arbitrage, there's not a ton of stocks that have multiple share classes, but there is a few. And some of these are actually, surprisingly, they do deviate from each other from time to time. So you have VIAC and VIACA. The only difference between VIAC and VIACA is voting rights. So the voting rights are in the VIACA. VIAC does not have voting rights. Amazingly, we've talked about this before. What happened was, and I'll just give you the little story behind it. The VIACA, I think this is going back a couple of years ago, became hard to borrow all of a sudden. And I watched this relationship, which it used to be about $1 apart, sometimes $2 apart, what they were giving the voting rights. I watched this relationship over the course of a few weeks blow out from $2 to $15, all because the locate became tough on the street. I'm not sure if it's Redstone that all of a sudden decided he wasn't going to lend out his shares because he owns like 90% of it, or what happened, but VIACA exploded in a really classic short squeeze, and VIAC didn't move. We saw this happen with Discovery this year too, and I'll show the charts of that as well. So you do see sometimes these things can blow out just because the locate could be tough, or you get these Reddit short squeezes attacking them. So Google, this one's very liquid. It's never blown out to my knowledge, and in a way of like percentages, but they do deviate. Can you pick up a 1/4% or a 0.5% on some of these trades? Sometimes, yeah. Sometimes at the open they can get out, but Google is very efficient. LGF.AB, that's a thinner one. There's probably a little bit more opportunity. UA versus UAA, I love trading this one on earnings. It can get out to lunch as much as 1%, 2%, 3% on an earnings report, which is significant, because the thing is, when you're picking up 1%, 2%, 3% on some of these arbitrage trades, it's not like, picking up 3% on a directional bet. The probability when these things get out 2%, 3%, 4%, the probability of winning on those trades is extremely high. And I would gather in some cases it's over 90%. So if I have a 90% chance of making 3%, I'll go for that over the 50% chance of making 3% on a directional bet. So there is some opportunities on earnings around UA versus UAA. Fox, same thing around earnings. You might see some opportunities. You might see the odd opportunity at the open. It does happen. I'll show you a DKNG example with DraftKings and GNOG and risk and later on in the presentation. So they do have some different opportunities. Intermarket arbitrage, again, are just stocks that are interlisted. So like I said, there's more than 100 companies that are listed on the NYSE. These are Canadian companies listed on Toronto and listed on the NYSE or NASDAQ. Ballard Power is one, Shopify. A lot of people don't realize Shopify, Ottawa, Ontario company. So, these are trading in both markets. The only difference between Shopify price in Canada and the Shopify price on the New York Stock or on the NASDAQ is exchange rate. So you just take, the Shopify price times the exchange rate will give you the price in Canada. High frequency traders will keep that in line. If it deviates from that, they'll do the ARB and, make the money from that. I used to do a lot of that back in the early 2000s. The HFTs are so efficient at it. That's why I'm not going to go into depth in it because it's really hard to make money from intermarket arbitrage now. It's 156 European stocks trading on the NYSE. Again, this is dominated by high frequency traders. Don't think you even as a bright trader, very difficult to make money extracting alpha from intermarket arbitrage because it's so efficient. The good thing is the high frequency traders are so good at it. You can come in at 7 o'clock in the morning and see like a 2-cent market in Deutsche Bank because it's trading over in Europe. So the high frequency traders are just surrounding that. If you're on the bed, you can get a tighter market. If you go back 20 years ago, there was to be no market for Deutsche Bank because there wasn't the automated machines doing that. So that's one benefit to high frequency traders is they do keep prices of intermarket listed securities in line. ETF arbitrage. So Rob just touching on this in his last presentation, Joel as well. The QQQs, you can see Apple's 11%, Microsoft's 10%, Amazon 7%. So basically 30% of the Qs is these three stocks. Huge, impact. So Amazon going, it's going to impact QQQ. SPY, same thing. These are top three components. So the top three components, I put the Googs together because they are the same company. 17% almost of these three stocks is the SPY. So the other 500 companies make up the other 83. So you can see these three companies have a major impact on SPY. XLF, a lot of people don't realize they think they're trading, XLF. They think they're trading just the banks. The top holding in the XLF is Berkshire Hathaway, which is clearly not a bank. So you can see it's financials. And Berkshire Hathaway is a financial company. Obviously, it's Warren Buffett's fund that buys and sells. But, Buffett's one of the major holdings, Coke. Absolutely nothing to do with banks. So, Berkshire can kind of throw out the XLF sometimes. But it's good to know these percentages if you're trading these ETFs. IWM is equal weighted. What does that mean? It means the 2,000 companies in there are all rebalanced quarterly to have equal weight. So you won't see if Apple got up and was dominating the index, you won't see that in the IWM. They will rebalance it. But we're going to show how social media can impact that as well. Because in some cases, they only rebalance quarterly. They don't rebalance daily, where if a stock has a really significant move, like a GME, it can start to dominate the index. XRT is retail stocks. It's equal weighted. I'm going to show you how the GME took over XRT in January. So here we go. The GME effect on the XRT. So the XRT, which is the retail ETF, is equal weighted, but it only rebalances quarterly. So when you have the GME stock, which we can see back in January, move from $30 a share to $470 a share, I believe it was trading intraday on the one day, that will impact XRT because it'll start to take it over. So it starts the quarter as, let's just say roughly, of 0.8% weighting, which is what it was. And at the peak, GME actually became 20% of the XRT. Then they rebalanced it in March, and then it brought it back down to the 0.8%. But I can remember when I was first trading XRT, because I would trade XRT against, doing it against Kohl's, against Macy's, against Nordstrom's, against some of the retail stocks. If retails were hot, I'd buy some XRT. And I can remember like on day 3 or 4 of the GME move, I was like, what's going on with the XRT? How is it up 6% right now? And then my other friend at Bray Trading is like, it's GME. And I was like, oh my goodness, GMEs went up so much because it went up to $300. Literally, this is 4 days. It went from like $30 to $300. So that 0.8%, you got to multiply times 10 So there you go. And obviously, at the peaks, it became 20% of the XRT. So, you're looking at, all the retail stocks trading flat and XRT is up 6%. I'm like, how is this possible? And it's because it was such an extreme move in GME that it became that dominant in the index. So absolutely incredible movement. So you have to be aware that even if an index is equally weighted, if you have a move within 90 days, a really extreme move like GME, that can start to take over the index. So XRT became just a tracker. And when it was up to 20%, it became basically a tracker for GME until they rebalanced in March. So ETF arbitrage and rotation within the index. I talked about this in my other presentation. I want to mention it again in this one because it's a very important topic. Back to April 12th, 2019. This is an older slide, but it applies every earnings season, and Facebook earnings are coming up. Amazon earnings are coming up. They're so heavily weighted within the Qs that they can impact the overall action within the Qs. So this was a scenario back in 2019. Facebook beat earnings and is trading up 9% after hours. It makes up 5% of the Qs. So Facebook is approximately 5% of the Qs. That means just for the Qs to account for the Facebook movement, because Facebook was trading up 9%, you got to multiply times the 5. That means the Qs have to go 0.5% higher just to account for Facebook. That ignores all the other 99 components. Remember, if Facebook's trading higher, it's probably going to move up Amazon. It's going to probably move up Netflix. It's going to probably move up Google and Microsoft and Apple, because they all kind of tend to trade together. So that is going to cause havoc within the index itself. And what you will see is that non-tech components of the QQQs actually go down because Facebook is too strong. Does that blow your mind? It should blow your mind, because imagine going to the CEO of, let's just say, Walgreens, and because WBA is part of the QQQ. And let's say, you said to the CEO of Walgreens, your stock is going to go down today because Facebook is too strong. They'd be like, that doesn't make any sense at all. But that's exactly what happens when you have involved ETF arbitrage. And this is what happened the very next day, the next morning, with Facebook so strong. If you look here, and this isn't my screen from Ready, but if you look here, these are parts of the QQQ. Pepsi is in the Qs. So you think of the Qs as just being a tech index. It's not. There's 21 components that are not tech, believe it, in the QQQ. Pepsi, Costco, Starbucks, Walgreens, Kraft Heinz is in the QQQ. You got a food stock. Mondelez is in the QQQs. Rail, CSX is in the QQQs. ADP, Ross Stores, Monster, MAR, Dollar Tree is in the QQQs. MYL it's gone now, it's delisted. This was at that time. Fastenal, which is obviously the nuts and bolts, they produce nuts and bolts for construction and for auto and everything else, is in the QQQs. Hasbro is in the QQQs. Fox A in the QQQs. So obviously, there's a lot of stocks here in the QQQs that are non-tech. Comcast is in the QQQs. So what happened was Facebook trading up 12 points, Amazon trading up 12 points. They were up so much that the QQQs weren't up enough. So what do arbiters do? Well, if they can't, if Facebook and Amazon are up too much to account for the QQQ action, they will actually bring down the non-tech components of the QQQs. And what you saw was Philip Morris, and what you saw was Pepsi and Costco and Starbucks. Not Philip Morris, it's not in there. Pepsi starts here. Pepsi, Costco, Starbucks, Walgreens, Kraft Heinz, all trading significantly lower. Why? Media will chalk it up to rotation. It's actually, or chalk it up to like, oh, these stocks, we're just buying tech stocks today. But it's actually an ETF effect that makes that happen. And these stocks here were all trading significantly lower. So you, understanding that Facebook and Amazon are having a really good day, may not want to be buying Costco that morning, may not want to be buying, Ross Stores that morning, may not want to be buying Dollar Tree that morning, because the money is not only rotating into the tech stocks, it's actually rotating out of all of these other names, not just because of the index effects of it. So because Facebook up too strong, QQQ is not up enough to account for Facebook and Amazon and Microsoft, they bring down the other components to make up the difference. So it's a fascinating, thing that's been happening for a number of years, and it's rotation within the index. And I would say 99.9% of traders out there don't even realize this exists. So you are now part of the 0.1% that realize it does, and that will give you an edge. So risk arbitrage, let's talk into there. So this is just stock deals. This is another name for stock deals. I'm not interested in looking at cash deals, because cash deals, the stock is taken over the cash and it's over. We're looking at stock or stock and cash deals. That's where some opportunities are. So I'm trying to extract alpha from the relative mispricings. And the risk, why they call it risk arbitrage, is there's always risk that a deal might not go through. Just because they've announced a merger agreement, maybe something happens. Maybe the deal doesn't get approved by regulators. Maybe they just decide it's not best for them. Maybe they kill the merger. So there's always a risk. So ignore the charts at the bottom. I was just trying to show between risk arbitrage here that Bristol Myers and Celgene, when they were doing the deal, you can see how correlated they are. Very, very correlated. But Zoom and Five9, this merger fell apart a week and a half ago. So there was strong, obviously, relationship between Zoom and Five9. It's instantly gone when the relationship, when the merger deal closes off. And what you'll often see, you can see the stocks going opposite directions. In the case of Zoom and Five9, they actually wasn't a very strong, because both stocks had been weak, and I think they just both decided it was best without each other. Where do you get all this news? So the one thing, if you want to just go get all the current deals, a great website, right? You can go this and you can write this down. Just Google the risk arbitrage report. This is the actual link. If you're obviously, if you're watching this presentation, you can just type that in as well. But if you just Google the risk arbitrage report, you'll get all the information on the current deals. And I just took a snippet of just the top of it, but there's a bunch from there. Like I said, I'm not looking at cash deals. I'm looking more at the stock deals. Cash and stock, you've got to just, adjust for the cash proportion, take that out. But I'm looking just at the stock deals. Now, I'm not trading Afterpay and Square, because I'm not trading this because it's not actively traded over here. But there's a lot of deals that I am currently trading, and let's go into them. So current mergers, we've got a bunch of them here. I've just got them all written down here, but let's start at the first one. So we've got, this is one that I'm trading actively. I love this one. It's Golden Nugget Casino, GNOG. DraftKings has agreed to buy them. So they're buying them, and the ratio is 0.365. But what you need to know is just percent per percent, really. So if DraftKings is up 2%, GNOG will be up 2%, relatively speaking. Again, if the close is weird or opens weird, there can be some stuff happening there. But generally speaking, they track each other percent for percent. When you've got a cash component, they will not track each other for percent. Like KSU and CP, you've got to actually go to this ratio of 2.884 because they got to adjust for the cash. So right now, KSU will only move the 2.884 and not the whole amount because of the $90 there. So, but these are all the deals that I'm currently trading right now. Xilinx and AMD was blowing out a little while ago because there was rumors. One, they didn't know if the deal was going to get approved by regulators in Asia. Two, there actually became AMD got hot on Reddit, and Xilinx just wasn't keeping up. So I was learning the hard way there that I was like, okay, well, this relationship is now souring to a certain extent just because of social media, which is incredible once again. This merger announced just a couple of weeks ago. KL and AEM, obviously two gold producers, they're trading percent for percent. So that's a nice one to trade. Both are fairly liquid. SPGI, these are higher price stocks, so it's a little bit more difficult to trade. And then you got some banks. The banks behave well. They're kind of boring, but they behave better. So there is some opportunities there. So risk arbitrage at the open. This is where sometimes the best opportunities are, where stocks will just get out to lunch, just like I was saying. Stock might open too high or too low because of one big buyer or one big seller. So let's look at the open. It's a very inefficient event. We've talked about that already in our last presentation. The opening can be impacted by just one or two major players. And sometimes deal prices can open away from their fair value. So again, I'm going back to that OPG order. I use OPGs, or if I'm trading the close, you use what's called a LOC order. That is limit on close, to take advantage of those relative mispricings. Third Friday options, which just went by, is usually the best opportunity for that. So actually, I'll just give you a quick example here. If I can just go, here, I'm just going to get out of my presentation for a second. You're seeing my screen. I'll show you the chart here. I'll bring the presentation up here in a second.
Yeah, if you want, just stop sharing, and when you're ready,
it's okay. I'm not showing much there anyway. So I just want to show you the charts of D. So this is DKNG and GNOG. Obviously, you can see those charts are virtually identical. If we just go down into yesterday's chart, though, you see this tick on GNOG. This was the open on GNOG. If you look at DKNG, you won't see that tick. That was GNOG actually opened about 1.2% too high for where it should have been. And it instantly came in. Within 5 seconds, it's right back in. So I actually was able to sell this price which was, I believe, 1805. And you're back at 1780 in seconds. So it's 25 cents, just free money basically there, just because the stock opened too high. So I'm going to go back into the slideshow. I don't know if I can continue here. I'll just go back. So I just wanted to show you those charts, like to show you there's different opportunities. That was the GNOG and the DKNG. The inefficiency of the open allowed me to sell GNOG about 1.5% too high relative to where DKNG opened. So continuing on, so you can see there's opens a very inefficient event. Now let's talk about the social media impacts on arbitrage. If the stock gets hot in social media platforms, it can deviate away from relative pricing. If you look here, this is DISCB. This is thin. So there's three discovery stocks. There's DISCA and DISCK, which are both very liquid and trade very closely. Then there's this loose DISCB that's loosely correlated. You can see it there, but it just seems to do its own thing sometimes. Anyways, for whatever reason, it decided to explode about 3 weeks ago and went from $45 to $70. You can see Discovery, the main stock, didn't do anything in that time. So sometimes, it gets hot on Reddit and people are buying it. The main point I just wanted to make was not trying to so much profit from this, but don't get caught up in the hype. If you see a stock like this DISCB exploding and think, okay, this is the one, and the main companies are going nowhere, in all likelihood, this is probably going to eventually, once the buzz settles, return to where it should be. And that's exactly what occurred 3 weeks later. So everybody buying this is 65.70, thinking this is the next big short squeeze, got burned. So I don't want you guys and girls getting burned here. So I just want you to be aware that these relationships are very strong and they almost always come back in. So what are these social media platforms that are impacting arbitrage relationships? Let's take a look. Reddit. So Wall Street Bets. This is maybe the start of it all, where you really had, social media has always been Twitter. There's always been certain things that will impact price to a certain extent, CNBC as well. But Reddit was the explosion back in January where stock GME got on Reddit and they're all talking about it, and Value Kitty, or whatever the kitty guy's name, Mitch can probably help me with that. I forget what his name was promoting it on YouTube videos.
The Roaring Kitty.
What was his name?
Roaring Kitty.
Roaring Kitty, Value Kitty, Roaring Kitty. Anyways, he made GME roar. And we saw GME go from $5 a share to over $400 a share. It's still holding up there, all impacted by Wall Street Bets. And, and then we saw the Wall Street Bets trade happening in January. We saw all these stocks explode, and high short interest stocks exploded. And you saw AMC explode. And all of a sudden, Reddit was taking over the markets. It was very interesting for a bit, but eventually a lot of those stocks did come back down to earth, although AMC and GME, their own animals, have held up fairly well. Twitter, there are very influential Twitter accounts that will move price, and you have to be aware of them. I'm going to give you a couple of them here today. I don't know these people. I just know that I follow them on Twitter because they can move price. So you have this at Mr. Zach Morris and at Real Will Mead. These guys mention some of these smaller stocks, sometimes penny stocks, some of these smaller companies. They, say, oh, I like this, and it's a new pick by them. They will move price. So you have to be aware. I don't know if you want to participate in them or not, but you just have to be aware that these accounts are market moving accounts. I'm not going to comment on, what they're doing, on legalities to what they're doing or anything like that. I'm just saying that these are influential accounts. Obviously, Kerrisdale and Spruce Point are on the other side of these things. Maybe these two, whoever is behind these accounts, are mostly long biased. Kerrisdale and Spruce Point are hedge funds that are mostly short biased. So you actually had, I believe it was Kerrisdale that came out and hammered one of the Mr. Zach Morris picks, which was CEI. So Mr. Zach Morris had the CEI pick, and the stock exploded from about 50 cents to about $4. Kerrisdale came out with a short report and knocked the stock down from $4 to under $1. And it's come back up a little bit since then. But these two accounts going basically head to head, interesting in that CEI. This is all just social media, really nothing to do with the companies, just basically people, that have a huge following that are very influential when they make a stock picking call. Spruce Point, same thing. They're a short seller like Citron was. Citron, one of the first in the business to do it. Obviously, they're not doing shorts anymore because they got blown out in the GME. But Kerrisdale, Spruce Point, these are two Twitter accounts that you should be following as well because they will move price. Discord, Atlas Trading. I believe Mr. Zach Morris is part of this Atlas Trading. I'm not sure if the Will Mead is, but there's a bunch of other accounts. There's PJ. Atlas Trading, very influential. So some people that say they do a little bit too much promotion, it's not my place to judge any of that. It's my place to just say that they are very, they can move price. So you have to be aware as a trader, if they start mentioning your stock and you're short it, you could be in trouble. If they start mentioning your stock and you're long it, maybe you want to take advantage of that. So just saying that these are influential platforms. Media influence, perhaps the most influential person in the last 20 years to individual stocks, not talking like CEOs, but is Kramer on Mad Money. He mentions a stock just out of the blue on CNBC and say, I'd like to buy it. He can turn a stock around on a dime. Kramer is very influential. Love him or hate him, he moves price. And then ARK funds, we had this Kathy Wood trade going on the whole first part of the year. She'd buy a new stock in her fund and the stock would explode 15 to 20%. We're not seeing that now. We're not seeing hardly any moves. She's lost a lot of her influence for the simple reason is that her fund has drastically underperformed the market in the last year. So obviously Kathy Wood got famous for her Tesla call. Back when Tesla was $200, she said it was going to 2,000. That happened. This was before the split. And that's what made her name so strong. And everybody all of a sudden decided that she knew, everything about the markets. And they started following her picks. And what she has is an email. You can subscribe to it. And her trades of the day come through on that email. So it was working very well for a while where you just, where some of these stocks, she'd put them in, and she'd get the email, and then the stocks would move 5, 6, 7% sometimes because Kathy Wood bought it. Again, I'm seeing a muted response to it. I hardly even look at those emails anymore because there really isn't much response. There might be a small response, but it's not, there's not as much influence as there was 6 months ago. She's lost a little bit of her influence, I would say, in the markets.
All right, let's go ahead and wrap it up here with high short interest stocks.
Are we running out of time?
We are almost out of time. I need to bring Rob back on so that we could get towards the end and get everybody in. Okay. So let's cover the high short interest stocks, and then
we'll go 5 minutes here. I want to go 5 more minutes because I feel like I got cut short here. So I started late, way late. So again, high short interest stocks. Social media loves to talk about short squeezes, and they want to come in. They want to squeeze the shorts. We're going to put the hurt to Wall Street. So you do see some high short interest stocks from time to time get squeezed, and these are usually short-lived. A great site that I go to, if you see the high short interest trades start to get hot, is highshortinterest.com. We're trying to give you guys lots of information here today. So highshortinterest.com. Sorry about the background. My kid is doing something if you can hear that. But anyways, this is a great site to find out what it's got a high short interest. I'm not saying just come on in here and buy it, but when the short squeeze trade really starts to get caught hot, some of these stocks like to go up. So you can go there. This is changing all the time. This is just a snippet. But I did make some good trades off of this site back in June. What we saw was Bed Bath & Beyond exploded one day, went from 30 to 40 in a matter of about an hour. So it quickly ran up 20%. And so it quickly ran up 20%. And what you saw was, okay, that was a tip for me. So my kids are nuts. So I'm sorry if you hear that in the background. That was a tip off for me. So knowing that Best Buy had just run 20% on a short squeeze, I'm like, they might squeeze these other names. So what I did was I quickly went to that website, highshortinterest.com, and I started buying all of the stocks on that list. I think I went through, there's like 50 stocks on the list. I think I bought about 30 of them. And I was able to make like 10, 15, 20% on some of these stocks in a matter of hours. It was just an epic. It was one of my best trading couple days in a long time. So like I bought, and these were ones I bought. I bought Clover. You can see right here, it exploded. I sold some of these. I sold way too soon. Workhorse I had bought, Geo I had bought, and Root I had bought, all because they were on that list, and they all exploded over the course of a couple days. So what I can tell you is, okay, well, you say, okay, I bought these stocks. Now what? You've got to take advantage. When your stock pops 20, 30% just because it's getting squeezed, what do? You hit that sell button. So maybe you sell too early. I think in the case of Workhorse, I made about 15%. I sold it. I could have made like 75% if I would have held for a couple of days, but I got out too early. A couple of these, the Geo, I really took a good one on that one. It was 6. I sold it like 9. So that was like a 50% mover in a day. So you can see there's sometimes opportunities in that. But when to sell? So I want to say Harlan Payan. who was on pre-market prep for a long time. We haven't had him on the show in a long time. I don't know what he's doing, but he always said, sell your peanuts while the circus is in town. When you see your stocks exploding 50% because they're on a short squeeze, the circus is fully in town. So you take advantage and you sell. You're never going to get the top, but you know what? You take the profits while you got them, or the market will take them for you, because a lot of these high short interest stocks have high short interest for a reason. It's that they're often struggling companies. And a lot of these high short interest stocks return to where they were. And if you look at all of these cases, Bed Bath & Beyond, $40, we're going to squeeze those shorts. You know who got squeezed? The longs. Stock's $14 today. AHT was another one. We're going to squeeze these shorts. You know who got squeezed? The longs. The stock is $13 a day. Root, we're going to squeeze these shorts. You know who got squeezed? The longs. The stock is $5 a day. And again, this recent one, CEI, which we were just talking about, the Zach Morris was pushing the price up, and then Kerrisdale destroyed it in basically a day, and it was back down there. So, I mean, a lot of these stocks don't come back either. So you don't want to get stuck with these things. If you are trading these hype stocks, get out while the circus is in town. Don't get stuck holding these even more than a few days or a week, because after a few months, they usually are back down to where they came from. So in summary, I'm just going to, obviously I flew throughout material because we're running behind. I want you to understand there's different types of arbitrage, its impacts on the markets. Understand that risk arbitrage traders are extracting alpha from the stocks when the pricing, when they deviate from their deal pricing. And then understand the social media influence, the boom, the big run up, the bust in price, and then the aftermath. Don't get caught up in the hype. Sell your peanuts while the circus is in town. If you're lucky enough to be in some of these stocks, like Corsair, I had that one, CRSR, I think it was. And it was on Reddit one day, and it went up 25% in one morning because it was a hot stock on Reddit. I hit the sell button. You know who else hit the sell button? All the insiders, and the stock has never come back since then. So market wants to give you, a gift overnight because it's hot and talked about on Reddit. I use that gift and I usually ring the register. So that's it for me. I will stop sharing my screen here now. If I can find the Zoom, which is right here. Uh-oh.
So I know for sure that last segment there will be played on replay plenty of times. I know that a lot of people are going to go ahead and go back and listen to it. One thing that I even mentioned is sometimes, like when I was listening to you, Dennis, talking about, you were talking about the Qs and how I think I forgot what stock it was, but it was up 10% and how that affects the Qs. We can take that in conceptually while Dennis is talking, and then go back to that slide and see the math. Practice it yourself so that you can learn exactly how to actually implement the concept there. All right, let's go ahead. Let's
go back and
Rob.
rewatch this stuff because we had to fly through it because we were running late. So I flew through this. Go back and watch it slower. But there's a lot of information I've given you. And like I said, if you want the presentation, I can also send you the presentation. We just got to verify that you signed up for the event with your email. Reach out to me at DDD Trader, and I will send you the presentation.
Perfect. Appreciate that, Dennis. Let's go ahead. Let's get towards Rob. I know that you guys enjoyed Rob's last part. Now he's going to go ahead and continue getting in here. So let's get these odds going here.
Sound check. Can you hear me?
We got you, Rob.
Plug that back in. I guess it didn't work again here.
No worries.
Sound check.
We're good to go.
Okay.
You got it, Rob.
Dennis, on that subject that you just talked about.
Yep.
I've had so many traders contact me that have given back all of their money that they made in January through March with some of those short squeezes and the pump and dumps, and they've given all that money back, plus they're down way more than they were before. And the reason is this, is that when you look back and you had an experience or you had a profit from something like that, that is really truly an anomaly. It's not something that you can repeat every single day. It's not compoundable. What they end up doing is they're going back in thinking that, Rocket's going to pop today, or AMC is going to have another big pop or whatever. So maybe they believe the narrative that's going on, or maybe they just say, oh, it's starting to move up. It's going to give me that same thing that I had before. And invariably, it just grinds lower, and they keep losing trade after trade after trade. And it's so disheartening to see. And I've talked to a lot of people that are really frustrated with that. And it's this whole FOMO. It's fear of missing out causes you to go in and take trades that have no positive expectation, right? There's no edge there.
They're
Okay.
chasing story. And
Right.
this is the problem. These social media accounts, and a lot of these, and I'm not going to, it's not my place to say who's pumping and who's dumping, but everybody's out there on social media. There's a lot of people talking their book. And, some of these people are actually selling it to the people they're talking about. And the regulators will have a problem if that's actually occurring. Anybody's allowed to talk their book. What you can't do is go out and promote your stock and sell into the hype. That's actually called a pump and dump, and it's illegal. And if some of these stock promoters are doing that, the regulators will hunt them down and find them.
Right.
But at this, time, the problem is there's so many people who are harmed by this because, like you said, Rob, they get caught up in the hype and they're buying the stock. Everybody's talking about it. Oh, this stock, we're going to squeeze these shorts. We're going to put it to Wall Street. I think the AMC ends badly too, eventually. I think, a lot of the apes don't actually, I think AMC doesn't actually go to $4,000 a share, $1,000 a share. I've said on the show, I think it eventually goes back to $5 or $10. I don't know when that occurs. But I don't think it, and nobody knows anything really, but
Right.
You've just got to be very careful that you don't get caught up in the story and the hype and this is going to happen, because a lot of times it's just a story that's to benefit a few select people out there, and a lot of people get harmed by it.
Right. It's, you can't make a career out of playing the lottery, and that's what's happening.
These are lotteries. Yep.
Okay.
That's exactly it.
All right. I better get on with it here. So if you can see my screen, so we ended with this seasonality, and basically, historically, financials have done better than the SPY in October, so on. We can screen for high probability longs to capitalize on this opportunity. So we can go to our screener here, and the way it would work is you could choose, obviously from the S&P 100, 500, 1500, or all the listed companies that we have, or you could just focus on maybe the S&P 1500 financials. Or run the Russell 3000 and just sort by by a sector or by industry group. What this does is allows you to focus in on some high probability longs within that group. So if you expect to see a kind of a move up in financials overall, Dennis has commented a lot on what to look for. You can just go into here and say, let's just boil it down to the S&P sector financials. And we can either choose open to close or close to close, or 3 days, 5 days, 10 days, 20 days. So you got a lot of different time frames to choose from. But let's say I want to run a standard deviation. This is proximity to the lower Bollinger Band, or proximity to the higher Bollinger Band, or where it falls between the bands. I can just hit explore, and it brings up the symbols, sector, industry, the actual signal. So everything in stock odds is based on a signal and a subsequent odds and average performance, Sharp and things like that. So you have, think about it like this. Everything is signal based or event based. And then what is the subsequent probabilities of outcome, either up or down, and by how much? That's the way you have to think of this. So the only difference to that is when you get into the seasonalities, like we have in the seasonality almanac calendar there, then you're talking about what actually happened within that time frame. So if you're looking at the third Friday of the month, if you're looking at the last trading day of the month or the first trading day of the month, everything's based on what actually occurred. So then the probabilities are extracted from this may happen again. And we do see a lot of seasonality patterns repeating, things like that. Okay. So in doing this, you can export this to a CSV file, sort it, add your other color, import it into a trading platform, whatever you want to do. Okay. So moving on in our slideshow here, I'll go back to that. Move this out of the way for the moment. So I want to talk about advanced techniques. Now, this is really getting into some insights that I actually use, and I'll give you an example of what I used on Friday. So this is really being vulnerable and showing you exactly how to get the most out of stock odds. So an individual trading basket can tap into the characteristics of symbols. You can look at gaps, volume changes, indicators, it's not enough to know what happened. You need to know how many times that has occurred in a reasonable look back period and what the subsequent outcomes from those were on average. And this is where the stock odds analytics comes in. Take any list that you've curated from any source. You guys might have some great subscriber lists that you get from here and there. You can take any source and you can plug it into stock odds and see the average performances and so on. All you have to do is paste here your symbols, save changes, and then you can run through various screens and see what the odds and average performance would be for those symbols. So you don't have to rely solely on stock odds. You can get other sources and things like that. And let's run through a workflow example. So in here, in stock odds, I have a single stock file that's looks like this here. So it has tons of data points in there, everything from open 1 day ago, open 2 days ago, where it closed. It has VWAPs, it has all kinds of information in here, ATRs. And the thing is, I want to look at like ATRs for not just the 14-day, which is normally produced. I want to look at it in what's the ATR for 5 days, 10 days, 14, 20, 50. So like for Agilent here, its ATR recently is 322 or 350 on the 10-day. That's very similar to 14-day, 20-day, but much less than what it's done over the long sample. So volatility is obviously increased, and you can look at those kind of metrics and say, okay, is volatility rising or decreasing on my symbols? It won't be the same for every symbol. Part of this business, and I think that Dennis has covered it pretty well, is you want to really be informed and dial into the characteristics of an ETF, what's the components, and also which way they'll probably move based on their relationships and things like that. So that's been a helpful utility. So what I did on Friday was I took that single stock file and I sorted it by volume change, okay? And I also sorted it by first open to close move. So this is the move that happened the day before on Thursday, how much they changed. And then this is the volume change. So for example, if you look at that, make this bigger here, is that the volume increased on all of these symbols here, as well as there was a price change from the open to the close, okay? So I have in the file, I have volume 1 day ago, 2 days ago, and the volume latest, and in the 90-day average volume. We have pivot latest, and we have all the pivot numbers, and we have long betas and short betas and average betas and all kinds of things in the sheet, right? But in this volume change, that tells me that it went up from the open to the close on increased volume. That was on Thursday. So then I want to trade those symbols for the next day. So these are all the longs here. And I'll scroll down. You can see all the longs, and then it'll switch to all the shorts. So these were the ones that went down with increasing volume. Okay, they moved lower with increasing volume. So I've got a whole bunch of ideas for shorts and a whole bunch of ideas for longs. I took those and then popped them into stock odds. And this gives me my export. And I used the price movement from open to close on Thursday. So we got the movement that actually occurred. And then we have the odds and average performance. And then I create what's called an expected value only for the long side or for the short side. It's not a full expected value formula, but I multiply odds times average performance to get a realistic expectation of what to expect for Friday's trading. Okay. We also have a Sharpe ratio. We have maximum or maximum favorable excursion, maximum adverse excursion, lots of different things, average gain, average loss. So there's a lot of data points there, but this is key for me. And then I sorted these longs by expectation. So these stocks became the longs for Friday. And then these stocks became the shorts for Friday, right here. I couldn't get a locate on one of them, which was Nectar Therapeutics, wouldn't give me a locate, but otherwise everything was fine. And then on the long side, when I put my orders in at the limit, 2 of them did not get filled because they were gapping too much. So I do use limit OPG orders to kind of not pay too much or not sell it to too much of a discount. But these were my long choices and these were my short choices, okay? And so it produced, that basket produced about 0.22% return on capital. So the capital that's deployed, you always want to look at it in terms of what is your yield from it, what is your return on capital. And so it's a good measuring stick. You either want to look at things on a per share basis, penny per share, you know, how much are you making as you trade on a per share basis, or you want to look at it in terms of return on capital. So that just gives you some insight. So just to review that really quickly, I took the list, put it into the stock odds, and the stock odds screener that I would have used would have been this one here. I chose open to close from, move, open to close, this one, bins of performance here. Move open to close with open to close output for the next day. So it's telling me that in the past, when a symbol has done something, let's just run an exploration. You can see, for example, here. So when a symbol has done something, this is what it's done subsequently. And you can drill down here and you can see how many times in the past, how many events there are and what's happened. And you can look for any outliers that you may have seen or whatever. So they have the ability to drill down. So it's telling me that for that particular symbol, having done what it did, open to close, here's the subsequent odds and average performance for my next time frame, which I've chosen open to close. Okay. So then it produced what I showed you on that screen there, right? So those were my final shorts and my final longs. If I wanted to fill in, I have other symbols waiting that I can choose from. If I wanted to, if I couldn't get locates on a bunch, then I would fill in with something else, or I can use ETFs. Okay, so this gives you some insight into how to have an advantage when you trade on a statistical basis. It's just probabilities. It doesn't mean there's a guarantee of every symbol working out, but I would rather traders go wide. That means lower the size per idea, which will reduce your risk of ruin. So hedging reduces your risk of ruin to a large degree. Doesn't guarantee it, but it reduces it. Going wider and putting a little bit of capital into more ideas also lowers your risk of ruin. And so, in working with a broker dealer and having lots of traders that use firm capital, it's really important to me that the trader is protected, but also the firm is protected. And so we really look at things from, we're first risk managers in our own trading. We're firstly risk managers. And if you do that and you do it on a compounded basis by having a positive expectation for each trade, then it tends to perform pretty well. So my longs have a positive expectation, this number right here, all this positive expectation for the day. My shorts have an expectation to go down or perform lower for the day, and I'm combining them. Now, when the market rallies, yeah, many of those shorts go up too, but I'm just looking for them to slightly underperform the longs. And that's really the argument. If you can find advantage longs and advantage shorts and put them together, whatever, if the market stays sideways, hopefully you get that divergence. Your shorts go down a bit, your longs go up, and you make money on both sides. But when the market really rallies, your shorts are going to go up too. So Anyway, that gives you some insights. Let's move on. So the predictors. Most think of sympathy trades within the context of the day. Dennis spent a lot of time on sympathy trades, and it's a powerful strategy, maybe one of his favorites. But I'm going to show you a little different spin on it here, guys. An instrument moves and signals a corresponding opportunity. Just as stock odds has shown you that you can do your homework the night before, even the week or the month before, and know exactly what instruments you'll trade, what if you could, from insights created by a predictor, know exactly the trades you're going to take in the next day or the next time frame? What is the fundamental reason this works? So if you have a predictor move and it signals what to trade the next day, what's the fundamental reason that works or should work? Well, as we pointed out in slide number 1, when markets move intraday, market participants are adjusting the next day. So whatever has happened today, they've got to deal with, right? If you have a massive move on TLT, they have to deal with it the next day. Not just, so there's the pre-market, yes, and we can deal with that, and that will be somewhat adjusted through the day, probably not to perfect efficiency, maybe some run over the next day. But if something moves one day and nobody had a chance to adjust that much, then they're going to have to do it the next day. So there's a fundamental reason this works. And just to mention, no matter what you focus on, right? Whenever you're looking at charts and patterns and all those other things, by the way, I just should mention all those trades on Friday, I never looked at a single chart. In fact, most of my workflow for symbols is not chart related at all. Only charts are used for some of the predictors, you know, the leading indicators, things that, you know, if TLT moves and I notice it on a chart, yeah, I'm gonna respond. So stock odds presents sympathy trader. So we have this coming up here. Let me bring it up. Okay, sympathy trader allows you to take a sympathy universe, so similar universes to stock odds. You can pull from anything here, or you can just do the predictor itself. You can set a bin size. Bin size just means how many samples are going to fit into what statistical bin. Really important way to measure things, because you can't measure things just from one data point. You have to assemble a few similar data points and then say what's the subsequent results. So you have your bin size. You can choose a predictor that can be anything. It can be a symbol. It can be, you know, like any of the predictors I mentioned in the first slide, which was, you know, the US dollar. I use ETFs like UUP and things like that, DXO and things. Then if you set your predictor value, which is how much did it move? And then the predictor type, did it move that much from close to close, or over 3 days, or over 10 days? How much did it move in what period of time? Then you set your output. Do you want the next day, open to close? You know, what do you want? And the explore date and the look back period, and you got some other stuff. So let me show you some examples of running that. So the first one we'll look at is Chevron versus Exxon. So I went over that screen so we can look at what actually came out of this. Chevron moved minus 1.65% that particular day from close to close. I want to know what it's going to affect the next day. So it gave me a list, and it said that Chesapeake had odds of 100%, which is, hey, price to perfection, but there's only been 6 events. And the Sharpe ratio was positive. Average performance was really good. For open to close, to get 1.92% out of Chesapeake is a good number. So that was on the explore date of August 31st that Chevron moved. So I'm predicting for the next day, the next time frame after August 31st. And here's the drill down of those 6 events. Well, here's what, so it's predicting Chesapeake to go up. So here's what happened. This was the predictor. Chevron down minus 1.65%, Chesapeake up 1.86% that day. It's predicting that Chesapeake will continue to go up 1.92%. So the predictor brings to light the symbols that move in subsequent time frame up or down. So what happened? And there's Chesapeake the next day. Projected open to close average performance was plus 1.92%. Actual open to close was 1.56. So we're focused on the predictors. We don't necessarily want to trade the predictors. This is a mistake that a lot of people actually make. Instead of using the predictors for information for a leading indicator, they tend to get in there and trade them. You're far better off to trade the lagging things, the things that follow, the things that must move afterwards. In this case, we're actually able to predict out to the next day of what things are impacted. Let me show you the diamonds, a move that just occurred not too long ago here. Was
all right, just want to cut in here, Rob. Just want to give you about a 3 to 5 minute wrap up, if you could wrap up here.
No problem. So the diamonds moved up, which was a pretty big move for it, 1.48% close to close. I'm looking for an output of open to close for the next day in terms of what things it would affect. So I chose my sympathy universe to be Dow Jones Industrial Average. My predictor is the diamonds, of course, that moved. And I want to see what the subsequent odds are for the stocks the next day open to close. So as you can see, it said mostly these stocks, other than Amgen, CRM, and Intel, should be heading down. So we have some pretty good odds of really performing poorly. So there's the Dow move that happened there. So odds of being up, average performance. Okay. And so here's the results. And this will give you some more insights into baskets, what they look like. In taking the 27 symbols that had the projection of negative performance for the September 24th, so of those 30 that were listed there, 27 of them had negative performance indicated. Taking them from the open to the close and hedging those shorts with only the Dow Jones Industrial Average ETF, which is the diamonds, this is the results that would have occurred. So here's all the symbols. They're all going to be taken short. Here's the diamonds that are going to be taken long. And here's the results that actually occurred. So the total return on capital was 0.118%. So if you were using $1 million of capital, you'd make $1,180. Okay. So then this is the sample if you'd actually used the corresponding sector ETF against each one of these. So you just said, okay, I'm going to short all these and I'll buy the sector ETF that it's a member of against it. And then your performance would have been at $1,510 per million is what you would have gotten out of that. So that just gives you some insights into that. And I'll do one more with the US dollar. US dollar is a big predictor. I use, again, UUP for my proxy for that. And so this is results that came up here. Like it says the US dollar moved up 0.8% close to close. The prediction for the next day was that MRO would perform poorly. Nucor Steel would perform poorly. Schlumberger would perform, Oxy, EOG, COG. So all of these were supposed to perform the next day very poorly, and these would perform really, really well. So here's your longs and here's your shorts. Okay. So there's the move on the US dollar. So again, I'm not curating this stuff when there's nothing going on, but when a predictor has a move, then I want to see what is it going to impact the next day and get all this stuff, all the ducks in a row for that day. Okay. Back to this screener here. Let's see. I'll just put this slide up here. Oops. Okay, yeah. 1 sec here. Oh, sorry, I lost my track here.
No worries.
1 sec. Yeah, so I want you to email me, rob@mystockodds.com. If you want any information, you have to set an appointment to see me. This Sympathy Trader product, if you read Stocks and Commodities magazine, I do have an article on that coming out probably within a week or so. We are gearing up to be able to take subscribers for the Sympathy Trader product as well, but everything's on a wait list right now. If you want stock odds, again, that's the data that's behind Sympathy anyway. If you want stock odds, you have to make an appointment with me, and I'll see if it's a good fit for you guys. We just discuss what your needs are and how you're trading. I just don't want you spending money on something that's not going to make a difference in your life, your odds. So there you go. Thanks for listening. We appreciate your time, guys. I know it's a Saturday and it's valuable, so we appreciate you being here. Thank you so much.
Definitely. Guys, check this out. I know that stock odds you can check out and get there's a trial, right, for new users?
We don't have trials anymore. I do have on the screen just an offering if you want to subscribe for anybody in this class here today. You can get a discount. But basically, we just set an appointment and then we see if it's right for you, and you can subscribe either to the starter or the advanced or the pro if you want. Okay.
Well, there you guys have it. Go ahead and email Rob. You guys see it on the screen. Let's go ahead and bring Dennis back. We're going to get into Q&A here. We already went through some Q&A, of course. I wanted to get to it a little bit earlier. So some of those more important questions already knocked down. Let's go ahead, and if you got a question and you still haven't put it up, go ahead and start throwing it up in the chat now. I'm going to go ahead and start knocking some of these questions out. So first question I have that I want to get into is from Paul here. And it was intended for Dennis. It was Triple D. How long did it take for you to develop winning strategies? And was there a learning curve where you experimented with different things that didn't work out? And seems like you don't do many options. That was what
I am constantly experimenting with everything. And what I will say is what I do today is nothing what I did 10 years ago, nothing what I did like 20 years ago. What you need to do as a trader is you need to develop strategies. Some will work for this market environment, some will not. But as you get more understanding and more strategies, you'll realize, okay, this is the environment where this might work. Even like those high short interest stocks, 99% of the time, that's probably not going to work. But if you get time it right and you start to see, oh, there's a few going here, the rest might go, there's an opportunity there. From the learning curve perspective, I started with bright trading in 1999, right out of retail. I traded retail for 2 years. Started with bright trading in 1999 under Joel Alconin. He was the office manager in Detroit. Started in May of 1999. I lost my first 3 months. I was trading really small. I lost about $3,500. And I started to get back to even. I got back to even about 6 months later, and I've been profitable every month since. So at bright trading, my account has actually went up every single month for 21 consecutive years. So it can be fairly consistent.
Did you start out with 19 losing trades?
Oh, I know it's terrible in the beginning. Yeah. So my first week, somehow I made money just by BS luck. I mean, there's a lot of luck involved on any given day. And then the second week I could do no right. And I think it was like Tuesday, the second week, I had like 19 consecutive losing trades. And I was like, how is this even possible? I'm like, it's 50-50. You can buy it or sell it, right? How can I be this bad at this? So anyway, so there's a learning curve. Don't expect to just come in and start making money. There's definite learning curve, but the consistency, like Rob can talk to the consistency of our traders too. We probably got, a good handful of traders that are consistent every single month where, I don't think I'm an anomaly where I can be profitable every month. I think we probably have quite a few traders that are profitable every month.
Yeah. What's interesting, Dennis, is, let's just take the top 10, to 12 guys. There's about 8 or 9 different strategies really going on. They're so different, but there's one commonality. Everybody's hedged and they always have been. So it's again, making money from the differential, not making money on an absolute directional format.
I just want to add one thing to what Dennis said. He did have that streak, and he was, I encourage everyone, when they start out in the office to trade like 100, trade small, trade 100 shares, right? And he was on that streak for a while, and then, watching his P&L now every day, I said, you know what, Dennis, maybe it's time to go to 200.
When I started to be consistent,
yeah,
I had
and
trouble
he's
increasing the size. You just
yeah.
get comfortable.
Right. And then he
Yeah.
started to do it incrementally. And I just like a general thing here is, when the markets are extremely, volatile, you don't have to trade your normal size. You can still make the same amount of money with trading, a smaller size. And then also, when you're on those streaks, those winning streaks, yeah, you can play it, but when you're on the losing streaks and you're trying to come out of it, there's nothing wrong with like scaling back your size, and you'll find out that you scale back your size and you're like, oh, I'm hitting everything again. Sometimes it's just not so much your mind, it's not your strategies, but your mindset. And I think that's just,
Well, hey, Joel, I got something to add to that. When I started in 98, I had the privilege of sitting right next to Bob Wright to get started. And I had come as a retail trader. I had never shorted stocks before. So now I'm making this move to, this new environment. And I was having a real struggle with trading short. It's just the hardest thing to figure out when you get started. And so he said, well, just divide what you really want into two, and only short half initially. And then you'll actually want the stock to go a bit higher. Just let it get stretched out, and then short your other part of it. And that made such a difference. It enabled me to make that transition to being able to short stuff.
Definitely. Let's go to another question here. So this one's an interesting one. We actually got a couple questions from Tom Higgins, relatively in the same area, but I think he said it best on his last question here. So the main question is, when building an LOE or basket, how do you size each stock in the list, and what overall weights versus your buying power? Of course, risk is relative, but how do you implement that? I'll go to Rob. I think Rob will be perfect for this.
So when I start working with newer traders, I would just have them trade based on capital. So, even though the stocks have different volatilities and different betas, it's just an easier place to start to have them do, $500 per symbol or $1,000 per symbol at the most. And it's actually amazingly low variance and really quite balanced. I mean, it's amazing that it works at all, considering things have different betas, but it does. And if you take, it's harder to take 3 symbols long and 3 symbols short. It gets so much easier if you can get to doing 10 or 15 or 20 longs and shorts. So if you break it down to smaller size, that works best. Ultimately, you can graduate to being more specific to the stock's DNA, its beta, its volatility, its characteristics, its correlations with other things, and so you can, or even how much it's gapping up or down can be, part of the equation too in the morning. So yeah, it's really different strokes for different folks, and I don't know that there's a right way exactly. I just think that you want to move more to understanding the volatility of what you're trading and utilize that as much as possible.
Hey, well, I'll definitely take that note. I am right now still doing kind of more of the capital split between my positions.
It's a great place to start. There's nothing wrong with it.
That's starting point, and thank you for pointing me towards the direction that I want to be getting into.
In fact, even on limit orders versus market orders, as long as you took your symbols and just checked them in your pre-market quote monitor to see if any are really gapping a lot, you can actually run at market orders. You normally can't, but if you've really curated highly advantaged stocks, it's like you want those anyway. You just don't want to pay too much or sell it too low. So I just like to keep it really simple, as Joel was saying, to keep it simple. Just, what's the easiest way for somebody to just get started and develop a workflow? It's more about having a proper process and framework for your trading than knowing everything. You're not going to know everything, and you're not going to be able to consume all the information. You guys are pretty good at getting all the news and you know, getting on top of everything, but not everybody can do that. So just keep it simple.
All right, let's go to the next one here. So this one's pointed towards Dennis. So how are you able to identify and trade risk arb at the open within 30 seconds? Or just for another question that was also mentioned, how do you manage all these positions right at the open?
Great question. I get this question a lot. So let's just say, hypothetically speaking, I'm doing a lot of OPGs, and all of a sudden, and obviously I have overnight trades, so I'm exiting some of those. I got a lot going on at the open. But all of a sudden, I'm unhedged. So I have an opening event, and maybe I get filled on a lot of longs and not a lot of shorts. So all of a sudden, I'm long like $500,000 worth of stock, let's say hypothetically. What I would immediately do is, okay, I have too many positions. I'm not going to start exiting. I have market risk all of a sudden, because when you're hedged, you kind of have, reduced your market risk. So now I'm looking at my absolute dollars, and I'm saying, okay, well, I'm long $500,000 worth of stock. I have, it's right in the bottom of my P&L. Tell me what I'm net long. So I might be long like 2 million, short 1.5 million. So I'm net long 500,000. So now I have exposure. So what I want to do is limit that market exposure first. So I would probably do, historically, is I would just go to SPY and short $500,000 worth of SPY immediately. Now I'm market neutral. So now I can relax a little bit, and maybe some of those, some of the alpha that I'm trying to generate from the open is I can slowly try to extract that and start exiting positions. As I exit some longs, I might sell some SPY, offset it, keeping, and my goal always in my day trading account is usually to be out of everything. So I go flat every single day in my Bright trading account, somewhere between 10 and 11 o'clock. And then between 11 and 2, I've already said I don't trade between 11 and 2, unless there's something going on. If there's a Fed minutes, if there's something happening, I might come back to my desk. But 11 to 2, I go do whatever I've got to do, because I've just noticed during those times there's not as many inefficiencies to extract. So I'm not trading those times. But basically, going back to your original question, at the open, I get filled, I hedge, and I slowly exit the positions and work myself out. If I'm getting into some really, like, let's say I get filled on 30, 40 stocks, I automatically start going to the losing positions first. Because if I'm losing off of an OPG, it probably means that my thesis was wrong. And you're going to be wrong. If you have a reason you were buying a stock, maybe you missed something. Maybe you just, you got a bad call here. Go to your losers, start exiting your losers, cutting the risk, cutting the losers. The winners, tend to actually, work out in your favor, and they sometimes get bigger. So because maybe you were right on that call. It's like the other day I got long AT&T. It was Kramer. The reason I bought AT&T, one, I got an upgrade, but then two, Kramer comes out at 9:15 and says he's hated AT&T for the last 3 months. And he says, you know what? I'm starting to warm up to AT&T. I'm starting to like it. Well, Kramer is so influential, and AT&T is such a widely retail followed stock that it was a high probability event that just because he said that there's going to be buyers in AT&T that day. And I was actually filled on AT&T. I think it was like 25, 35 long. I hate AT&T. I say it all the time. I hate AT&T. Doesn't stop me from going long because, as a short-term trade though, just because you hate it doesn't mean you can't go long it as a short-term trade. So I get filled on that, and, and the stock pops up a little bit. I was letting that one ride a little bit. I'm working out of other stuff, but I was confident that there might be some follow through there, and there actually was. And, and AT&T continued to move higher after that. So, basically, first step, get yourself, hedged out. Second, slowly work out of your losing positions, and then eventually work out the winning positions as well.
Hey, there's something to that, guys. Definitely go back and even just listen to how he approached that is just golden within itself. Let's go ahead and let's get into a question here from Emily. This one's pointed towards Rob. She would like you to expand on core positions and trading, and how you work around those core positions.
I put up on the screen, this is GDXJ minus GDX versus GDXJ. So that's the senior miners versus the junior miners. So right now my focus is short the senior miners and long the junior miners, coming off of that premium. So trading around a core position is about holding some and trading some. So that's the daily chart over the last number of years. You can see that it's, coming off of a premium area. If you drop that to a 1 minute for the day, you can see obviously the line goes pretty flat, but there is movement. And you know, again, this is junior miners and senior miners. So on that spread ratio I have at 1.32 of GDX versus GDXJ, you know, there's 25 cents of movement in there per day on average, 25 to 30. So that's what it is, kind of similar to Dennis's stat arb, you know, class arbitrage and things like that. You have some movement, but it's really contained. And so if you see a great level, you can probably get a little bit more of a position. It comes in, you take a layer off, it goes back out, you can put that layer on, comes in and take it off. And so you might still be holding your first layer, but you're trading production on the other layers in and out. That's what I mean by trading around a core position for earning money, not just winning money through a return, like by holding something.
All right, let's keep going. So now I got one that's kind of more, I'm going to throw this one to Joel here. So Joel, you know, you have a lot of experience trading and you've been through the stresses of the floor. What are some of the things that you can do on the weekend to kind of get you ready for that swing on Monday?
Well, the first thing is like, you know, don't spend a lot of time on your computer on Saturday. Do other things, get away from it, whether you had a good day or a bad day. And then what I like to do, the thing on the weekends is just get a longer term perspective. I mean, I know, and one thing we're trying to differentiate on the show is people trade from, a lot of different time perspectives. So, but on the weekend, I think it's a time to focus on the dailies more, the weeklies and the monthlies, just to see where you're at on stuff. And then, on Sunday, ramp it up, do the levels for the week and set a plan. So, but it's always good. It's always good to take vacations and get away and do other things. Working out, I think, is an important thing to do. Just keep your mind off the market so you're not constantly thinking about it. But that's it. Just don't become so absorbed in it that you spend all day on Saturday trying to figure out what you did wrong on Friday. Just kind of like use the week, relax, reset on Monday and get ready or reset on Sunday, get ready for the next week.
All right. So the last question is actually going to be a question from me. I'm going to try to give a question for that. I've been watching and learning you guys from all day, just like you guys at home are learning. I'm learning also. I always try to better my skill. So one thing that I've tried to do, and I've tried to up my trading of stocks. I've gone from, first I did 5, then 10. Now I've moved up to about 15 names. I'm keep trying to increase that to try to learn to balance it all out. Now, I would like to ask Dennis and Rob, would a one share approach kind of work here to at least try to have a little skin in the game and trying to work the strategy? Of course, this would keep the capital really, really low. And of course, you probably aren't making much returns here, but would it be okay to work the system in this way?
Well, if you want to get it down to that level, then you might as well track the strategies just within a spreadsheet, like use Google Finance and Google Sheets, and it pulls in the data, and you can put your spreads in there or your baskets or whatever and track it open to close. So you can run a lot of different models that way. If you were going to, I wouldn't take the one share approach. I would say you'd probably have to crop it between symbols that are $10 all the way maybe to 200 or 300, and just live within that and do it based on a certain dollar value. Like you want to put in $100 per position, and how many shares is that? So on some you'd have one share, which would be too much capital but reasonable, and some you'd have 3 shares, 5 shares, 10 shares. But I think that would be a better approach than just one share of each.
Perfect. What do you think, Dennis?
I think you gotta get in there. Like I like, if you're talking like paper trading, Mitch, like, should you start?
So the thing that I always see, and I hear this from a lot of traders, right? There's the paper trading route, there's very little capital route, or just open my account, right? Like take the whole amount that you have and open the account. There's different approaches that you can take when you're trying to get towards that system. What would you recommend?
You
because
start
there's no
small.
way.
You've got to get real capital out there. I am totally against paper trading. Sorry. Like, I mean, maybe in your first few weeks where you're just kind of looking, and you want to jot something down, but to get involved, there's so much emotion. There's so many other factors that are happening in the mindset, the psychology, which Rob is excellent at talking about, the psychology behind. None of that applies until you get real money in there. So I think you've got to get, when I started Bright trading, I was trading really small. Joel say trade small, trade small, trade small. I would say that. Trade small until you're consistent, but trade with real money. If that's, Robinhood's awesome. I mean, you can trade with like $20 or something, or 30. You could even trade, really small. Just get a feel for it, but get a feel for real money. I mean, if you only got $500 or $1,000 and you want to open up your account, get it open, and then trade, with like $30 stock on this or $50 stock on there. That's fine, but get real money in there so you're feeling all those emotions that are involved in the psychology of the trader.
Well, thank you for that answer. I mean, I myself always keep trying to build up the system. And that's really what I think this event is really about. As you guys can see, the system isn't exactly the same for every trader. Just like it isn't the same for Rob, it isn't the same for Dennis, and it isn't the same for Joel. We all have to find what works best for our personality and how we can find consistency in the market. As you guys heard from 3 expert traders here, there isn't just one way. There's multiple ways to go about this.
For sure.
Maybe pairs trading is for you. Maybe sympathy trading is for you. Maybe it's risk arbitrage. Try different things and find what works best for you. I always say, take your data. As you guys can see, I'm sure Rob would agree with that too, and analyze your data to go back to see if you can execute your system. Because I mean, everyone can have a winning system, but can you execute it? I think that's always what.
And the slippage, Mitch, the slippage is what, people don't account for too. I mean, we didn't talk about, but there's some people talking about, the spread. And I mean, we know it's difficult, and maybe we need to do a presentation on execution. Let me know if you guys want to hear something like that, like actual order entry and order execution, because I will tell you, it's sometimes very difficult to get filled in this environment on your limit order. And what will often happen is, especially on a smaller cap stock, as you put your buyout here, you'll see, the low of the day is like right around where your price was. And, then it goes higher. I would say on a Bank America, that is a coincidence. But if you're trading something with under 50,000 shares a day volume, and you think it's a coincidence that your order was the low of the day and you didn't get filled, it's not a coincidence. They are leaning on your order for protection. So on something like as big as Bank America, it's not your 100 share orders isn't going to impact anything, but your 100 share orders on a thin stock that's trading under 100,000 shares a day absolutely impacts everything that is happening in the market at that point in time. High frequency traders will not only lean on a big order, they will lean on little orders too. So I always say, you got to hide your intentions, but you've got to get in there, with the execution. So
I just want one thing to add.
Yeah.
One thing to add on top of that is, especially if you're starting out, I mean, look at, some of these big cap stocks that trade a lot of volume are boring, maybe compared to some of these high flyers, but boring can be beautiful. So if you're starting out, look at these, these liquid stocks and look at the volume and the high, the high price stuff is the one that's going to have, is going to have the bigger spreads, and you're going to have to pay some to get in and some to get out. So especially for those that are getting started, I encourage you to look at, stuff. I mean, it can be over 50, 60, 70, $80, but, find that 30, 40, 50, 60. There's a lot of stocks with that trade good volume, that trade with the market, that have a good beta. So, you don't want to spend too much time trying to finagle an order like in a $600 stock, because a lot of time, if you pay up the spread, you're automatically going to be down on it. So that would be my advice along those lines.
One of the things that if your platform allows you to put some hotkeys together, and you can use limit orders, not market orders, obviously, but some hotkeys, and you can, when volatility is high, you might want to say 5 cents away from the bid, or below the bid, or 5 cents above the offer, 7 cents, 2 cents, depending if market volatility is low. But you just hit your hotkey on the hard side, and you're looking for a great fill. And if you do it on ARCA and you get rebates, you can get that credit back to you for the ECN rebates. So just providing liquidity, it's so easy to do when you don't have to get filled. When you like the spread price, you like the relationship opportunity, and you want to get a great print. And then after you get that one, you lock the other side on, right?
Well, it looks like we're definitely going to have to touch a little bit more order execution there. Everyone in the chat getting super excited about that topic. So we already know what we can touch on the next event. Please email us with some feedback. How'd you guys like the event? What do you guys want more, less of? We will always go ahead and try to improve these events for you guys out there that are coming in to learn. I appreciate you guys joining us today, because at the end of the day, that's what it's all about, is building up your skills and trying to get to the next level. I know that there was even someone mentioned in the chat that says they haven't given away their GME AMC gains, and they're looking how to get around that so that they can find some consistency. That's what I love to hear. Guys, keep working, and we'll see you next time on Pre-Market Prep Plus. See you guys next time.
Thank you. Thank you all.
Thanks.